Good afternoon, class. This is Kevin Matthews, and I'm the professor for Tax 351 and the corresponding graduate class. As I've discussed, I will be out of town for the next week, so this is going to be a video that you're going to have to watch. So the beginning of this, though, what I wanted to kind of talk to you about is what exactly are we going to go over. I've already shot the videos. I'm going to have to go edit it after this, but basically what's ended up happening is, when we first talked in the last couple classes, I started off with the tax form, so that we could kind of see how things were kind of going in. And then as I was looking back on the slides, what I began to realize was that we hit a lot of things at the 34,000 level. And there's some things that I kind of wanted to go back and make sure that we had hit at an appropriate level for the class as outlined in the syllabus learnings. And so what I did is I went back and I took a look at that, and I'm going to go back and comment. So in chapters 4, 5, and 6, which are going to be the first three chapters we're going to cover in this, we've already covered probably about 90% of the material. Actually, probably 90 is a little overbearing on that. I would probably say it's more like 60 to 70%. So what I've done is I've gone through chapters 4, 5, and 6, and we're going to hit those kind of at a deep dive where we need to, but then kind of just say, okay, this is one area that we should have talked a little bit about that we didn't, because when we're talking about the tax returns, generally speaking, each tax return is going to be based on the information the client has, and some of it we've already talked about, some of it we didn't talk about, but I wanted to kind of give it. This is the way I told you we have the three circles. We have the preparation for the experience, and then the reflection. This is a way that you guys can go back and get another hit of the experience and do some reflecting on the topic before we get sort of to the end of that. Once we get past chapter 6, however, I've then decided I'm going to go ahead and hit chapter 7. And part of the reason for that is the morning class got chapter 7, and I already went through it, but first of all, I noticed there were several students missing, and then the second thing that I noticed about it was some of the topics that we kind of went through. I noticed that a lot of people, like I said, it's a 7 o'clock class. It takes a lot of energy to be there. I get it, and I understand that. I wanted to give you guys an opportunity to see it one more time so that it can kind of sink in a little bit better. The investment section is a very important section because 9 times out of 10, when you're going to be running into cocktail parties or whatever, and people find out that you're a CPA, they're going to want to talk to you about your tax knowledge, which, let's be honest, not every CPA does taxes, but you can at least know enough that you could say, yeah, this is my understanding, this is what it is, but I'd rather go talk to your tax advisor. That should always be your answer, by the way. Go talk to your tax advisor. Oh, I don't have one. Well, if you don't have one, here's somebody that I know that I would recommend you to. And keep a list of people that you associate with that do go into that tax business, because you want to, look, it's collaborate to graduate, but it's also collaborate to succeed. And I've learned that that's the case not only in school, but in business. You want to have that network of people that are droved up so that, and again, you want to be the answer person. You don't want to be the, oh my gosh, well, I wish I had somebody for you, but I really don't. That's not the answer you really want to give somebody. So have that knowledge, have those relationships working for you so that you can make others around you successful, including yourself. And here's the thing. If you recommend to somebody a good tax person, that tax person ends up really taking care of them, guess what's going to happen when you need them for a favor? They're going to reciprocate very quickly. And that's something that you probably want to make sure that you're keeping in your back pocket with all this. I don't really have anything else I'm going to say about this. I'm going to let the video speak for itself, but what's going to end up happening is I will put a quiz on Blackboard. There'll be an email that kind of details the mechanism that's on there. I've heard that there is an automated quiz availability on there. The other option is I'll just put something on Blackboard, you download it, you fill it out, and then you just may email it to me. I'm liking choice 2 because this video took a lot longer to produce than I expected it to, so I might just go with what's easy, but I haven't made up my mind yet. So if you have any questions for me, please reach out to me at my business email, and that's kmatthews, KMATTHEWS, at betasolutionscpa.com. Should have it down below where I'm speaking. While I'm overseas, I will be monitoring my email. I'm actually going to be doing a lot of work because I do have a lot of stuff that has to get done while I'm out of the country. And the people that I'm with understand that because we've already talked about it. But if you have any questions for me, anything that you need to discuss, any topics of relevance, please let me know. I'll be very happy to go over that stuff with you. And then, you know, as far as the rest of it, I'll just say good luck. Have a great week. If you have any questions, please reach out. Thank you. Greetings, my name is Kevin Matthews and I'm the professor for Tax 351 and for Tax 551. As everyone knows in the class, basically what's happening is that I'll be out of town for a week, and as a result of which, in order to maintain some certification requirements and then also to make sure that we don't lose too far track of the class, I'm going to go ahead and I'm going to make this video where we're going to kind of talk about the items that would have been talked about had I actually been physically present in class. A couple things about me. Well, so first of all, about this class as a general. The schedule basically said that we were going to be talking more about chapters 5 and 6. And I do the schedules the way that I do them because my intention is that, you know, I try to sort of set a pace for the class. And so if we go ahead and we set that pace for the class, what will end up happening is we can then make sure that we're staying in track, and that's kind of the way we do it. But as you guys noticed when I did the last 1 to 2 classes, depending on if you're in the morning class and the afternoon class, or the evening class, I'm sorry, what I did with the with chapters 4, 5, and 6 is that I actually just basically pulled out a 1040 and said, let's just go line by line by line. And for most of the stuff that's going to be going on in there, we're going to be hitting all the points that you know, and again, something that I've said in the class, and I'll say it here because I'm not ashamed of it. The way that we've sort of structured the course and the way that we do a lot of accounting teaching in the industry of teaching accounting at the higher education institutions. You know, there's a textbook, and something that I've noticed is that there's not really a focus of going on the tax form. Okay, what we do is we kind of talk about a lot of theories, we talk about a lot of stuff. Periodically we may refer to a tax form, but for the most part we don't really mention the tax forms again until we get to various points in the thing, and then it's sort of like a death by PowerPoint until you get to the point where most of you guys are kind of like, you know, I see the theory but I don't see the practice. Okay, and the way that I've always kind of looked at things, just from an organizational standpoint, there's sort of the strategic, the operational, and the tactical. And any of you guys who are prior military are kind of like, okay, I know exactly what he's talking about. But the strategic is kind of like that 30,000 foot level. Then there's sort of the operational, which is kind of more detail but less full detail, and then when you get to the tactical, it's kind of more of the actual doing of stuff. The homework is going to hit a lot of the tactical items, and they're also going to hit some operational items, because if you think about it, we're going to have you calculate certain things. Adjusted gross income, we're going to have you calculate certain taxes and things of that nature based on the homework, but also we're going to ask you generalized questions. For example, how much of the capital gains can be carried over from one year to the next. You can carry over all of it, but you can use up to $3,000 to go against ordinary income. And part of the thing about that is so that's like a type of a definition of how we would go to the operational level. The fact that you can use up to $30,000 every year of capital gains against ordinary income is sort of an operational construct. When we talk about tactical, we're talking about how do you put that on the tax form? How do you put that in the tax software in order to get the tax software to do what you want it to do? That's tactical. My thought process is we in the accounting industry tend to spend a whole lot of time at the strategic level. We maybe dip a little bit into the operational level, and then we never talk tactics. Okay, and part of the reason for that is naturally for actually a very justifiable reason. We don't know what kind of software you're going to use when you go to your tax firm. Okay, I don't know if you're going to use Pro Series. Are you going to use Go System? Are you going to use UltraTax or Drake? I don't know. Okay, and so because I don't know, I can't sit down and tell you, okay, when you're building a tax return, go to the slide, screen this and do that. That's a very tactical thing. In order to learn that, you need to do two things. Number one, do an internship if you can, because that's going to be very helpful for you if you decide you want to do a career in tax and that's the way you want to get it done. The second thing that you can do is that when you become a staff member, really focus on any training that they give you to kind of give that. Now, one of the firms I used to work at, I won't name them because this is a video and I don't want to do any unfair advertising for someone. When I first joined their firm, they sat me down and said, here's 10 example tax returns that we have built. We're going to give you this information that you're going to basically build the tax return, practicing where does it go, what screen do I go to, blah, 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 so on and so forth. That's a really good way to get that done. Now, I will be honest with you, I've worked at several firms. They and one other firm, pretty much the only ones that did anything like that. Most of them, what they're going to do is they're going to say, you're hired in December, we're going to give some initial onboarding training, and then once you hit January, they're going to be like, okay, here's the documents, go do your first tax return. And you're going to make a lot of mistakes. And then you're going to feel, you're going to turn in your stuff, you're going to make a lot of mistakes, and you're going to do this repetitively all the way through February, and you're going to start getting hits on your ego because you're thinking, gosh, I really didn't learn anything. And that's not true. You did learn a lot. But you're confusing that because you don't understand something at the tactical level, that you must not know anything about it. And that's not true. Okay, that's just simply not true. Your education, particularly here at GMU, will prepare you for various necessary things that you have to do in order to have a very successful career in accounting. Very good example of which is preparation for the CPA exam. You want to work in the accounting industry and you want to rise as high as you can go, you're going to need a CPA license at some point. And this course is definitely going to cover some of that. So anyways, I've spent a lot more time than I wanted to kind of talking a little bit about that. One of the things that I recommend doing when we're talking about this course, have a copy of the 1040 available. I'm going to have definitely 1040, Schedule A, and then Schedule 1. Now, some of you might say, okay, Kevin, well, we already talked about that in class. Why do I need it again? We're gonna dive in a little deeper in some of these things. When we talked about this in class, and I did it over a 2-day period, I really gave you about 4 or 5 days worth of material in 2 days. So obviously, we were hitting it at the really high level. Now in this video, we're gonna hit things a little bit more granular and hit the points that really need to be hit in order for you to understand a lot of the stuff that's going to be going on. You really need to pay attention to this video for 2 major reasons. Number one, you want to pass the midterm exam that's quickly coming up. You're going to need it. Number two, you are also wanting to pay attention to this video because you want to learn. Okay, look, guys, you're paying whatever it is you're paying for tuition. I don't know what it is. When I went to school, I went to a private Jesuit university, so my tuition was actually pretty expensive. I'm here for you, okay? And this video is here for you so that you learn. And like I've said in the classes several times, you put those 3 little letters after your name, CPA. They don't care if you're an auditor, if you're a financial accountant, or if you work for the federal government. You go to a cocktail party, they're going to expect that you know something about tax. Okay, because you have 3 little letters after your name. You say now, and there's 2 ways you can react to that. One, you can know enough in order to be able to at least tell people, okay, you have a real complicated problem, go talk to somebody who's an expert in this. Or you can just say, I really don't know. And then that kind of won't look good. Okay, because, there's just certain expectations that the public has about CPAs that you're going to know things. Okay, and so we want you to definitely have that knowledge and that together. Okay. The second thing that we're going to do, again, I'm going to probably focus a little bit more on the slides, but we're going to go fast because most of the stuff we've already covered. Okay, but one thing I was noticing when I was teaching the morning class on Thursday was that as we were going through the slides, there were a couple things that were kind of like, yeah, I didn't really talk about that in the forum. So there's going to be a few things we're going to really hit hard, okay, and when we hit the slides. And then there's going to be some other stuff that we're going to be kind of like, I already talked about this, so we're not going to worry about it. Okay, now my goal when I build the slides and I go ahead and do the edits, I'm going to put up a flash point of what that slide is when we're talking about it, so you don't have to look at this beautiful face the whole time. Okay, I know there's only so much of that can be taken by any human being. So let's start off with chapter 4. All right, so chapter 4, we talked about it's the individual overview. We talked about sort of the the calculations and things of that nature. One of the things that we and again we kind of talked a little bit about this in the investment section. You got to talk about it a lot more. There's different types of tax rates that can happen. Okay, so the biggest things, and I'm actually on slide number 7, if you guys are following along, and for some reason I can't get this thing up to the picture. You know, there's going to be different types of rates of you know, characters of income. They're going to have different types of tax rates. So, you know, you have tax exempt, which of course has no income. You have tax deferred, which basically says this year there's no tax, but later on there probably will be. You know, and a very good example of that would be 401k plans. I give you a tax deduction today, and then as your 401k makes all this money in it, you're not going to pay any taxes on that in that 401k until you make the withdrawal from it and take it into your own personal possession. And that's when you're going to have a taxable event. So obviously it's a deferred, because obviously that income was earned, you know, 20, 30 years ago in your 401k. You just didn't pay any taxes on it. Next, you're going to have ordinary rates, and then you're also going to have, which basically what are ordinary rates, before I go too far on that. Ordinary rates are, you know, like your marginal rate and your effective rate. Okay, basically that's going to be determined, whatever your marginal rate on your tax return is, that's your ordinary rate. Okay, and again, remember, what's the definition of marginal tax rates? Marginal tax rates is the tax of that next dollar that you're going to have. Okay, so we oftentimes call this the decision rate, and you want to make sure that you kind of know that, because the decision rate is going to give you sort of an idea as to you know, what kind of things are going to help you with your decision factors and things of that nature. Then we have, they say they have the qualified dividends rates. That's basically taxed at capital gains rates, which we'll talk about on the next slide, which is 4.8. Capital gains rates can be taxed, capital gains can be taxed at 2 different rates. You have short-term capital gains, and then you have long-term capital gains. Short-term capital gains are taxed just like ordinary income. Long-term capital gains are what they have. They have something what's called preferential rates. Now, preferential rates, if you go back to 4.7, what it's going to do is that there's 3 different rates that you have. You either have 0, 15, or 20. And the way that it's actually done is that it's done using the tax bracket that you fall under. So if you fall under the 10 or the 12% tax bracket, your preferential capital gains rate is 0. If you fall under the 37% tax bracket, which is what we call the max tax bracket, your capital gains rate is going to be 20%. Now, if you're falling any other of the tax brackets, you're at 15%. Okay, and that's really important to know, because if you're going to be doing any tax planning, obviously, if your asset is going to trigger ordinary income or capital income, that's going to make a significant difference in tax planning. And sometimes you can save money by people by recommending them getting into investments that have that preferential capital gains treatment. But the big thing that you need to know, that's very important, not just for any test, actually for a test especially, but something you're going to need to know for your personal benefit, really is that the difference between short-term and long-term on capital gains. Short-term is 1 year or less. Long-term is more than 1 year, and by definition of more than 1 year, it's got to be 1 year and a day. So if I sell it exactly 1 year from when I purchased it, short-term capital rates, and that's going to be at long-term, at the long-term, I'm sorry, it's going to be short-term capital rates. It's going to actually be taxed at ordinary income rates. So we want to keep our clients away from that if at all possible. Long-term capital gains, you want that to, basically the long-term capital gains are going to be at those preferential rates we talked about earlier. We talked a little. We'll talk a little bit about this in the investment class, but capital assets are generally all assets, except for if it's assets used in a trade or business, including supplies, inventory, and then accounts receivable. Now, when we say assets used in a trade or business, they give an example of supplies. That's a very good example. For example, I have an accounting firm. I go down and buy paper. Paper is not a capitalized asset. Okay, it's just I go out and I spend it. It's expensed immediately. Generally, anything that's going to last longer than a year of economic value should be capitalized. And I want you to understand that when I first came into the industry in the public sector, I'm going to say in the private sector, I did a lot of tax when I was in the Navy for many years. When I first worked at a CPA firm, this is when the capitalization regulations were coming out, and this was a huge hot topic. What is to be capitalized and what isn't? And it's still up for debate. Should an asset be capitalized or not? But they've solidified a lot of the rules, and so you want to make sure that you're following those as you're doing it. But accounts receivable and inventory are definitely not capitalized assets, and that's just by their nature. And I don't think anybody in accounting has a problem conceptualizing that. We'll talk about how to calculate gains and losses on capital later on. We've talked about this in the past. Deductions for AGI, from AGI. Don't use those terms in my class. I will not use them. The terms that we're going to use is above the line and below the line, and the reason is that the line is adjusted gross income. The for, from, always, I just think it's too confusing, and I don't want to cause any issues with that. Okay. One thing you do need to know, though, and this is just more for your edification, above the line deductions for AGI are always going to be more valuable than below the lines. And one of the reasons why is that a lot of below the line AGI deductions are contingent upon whatever your AGI is. So if your adjusted gross income is really high, you may not get as much deductions off of it. And of course, the main one right now, and I think is probably the only one really that's of consequence to most people, is medical. There's a 7.5% floor. We've talked about that in the class, where basically if you have $100,000 of income, you have to have $7,500 or more of medical expenses before you even get a deduction, and then it's only the amount over that $7,500. So it really does not, we try to reduce adjusted gross income wherever possible, basically when we're preparing somebody's tax return. So if we have a choice between taking a deduction below the line or above the line, which happens sometimes, there's times where we get to have that opportunity to have that choice, we try to push it to above the line wherever possible. And a lot of this we've already talked about, so I'm not going to worry about it. We've talked about different, and one thing we didn't talk about, and there's other types of taxes that you're going to end up paying also, in addition to income taxes. You're going to have self-employment tax. Self-employment tax is the combination of Medicare and Social Security tax. The way that it works is that everybody actually pays Social Security tax and Medicare tax, whether they remember it or not. If you take a look at your W-2, you're going to see 6 boxes. You got box 1, box 2, box 3, box 4, box 5, box 6. And box 1 and 2 is going to deal with federal income tax. Box 3 and 4 is going to deal with Social Security tax, and box 4 and 5 and 6 are going to deal with Medicare tax. Okay, and so what ends up happening in this is that the employer is on the hook for 1/2 of the tax, and the employee is on the hook for the other half of the tax. Now you might want to say, so how does that work with self-employed people? Well, when you're self-employed, you can't be an employee of your company. So that Social Security tax and Medicare tax still has to be fully collected at the full rates, which is 12.4% for Social Security, and then it's 2.9% for Medicare. Now what happens is 1/2 again is paid for the employee, 1/2 is paid by the employer. Now if you're self-employed, you're both employee and employer, and the IRS doesn't go without. So what that means is you got to pay both halves. However, paying an employee's self-employment tax is an ordinary and necessary business deduction. So what ends up happening is that you will be able to take a deduction for 1/2 of your self-employment taxes on your tax return. And the way that you'll actually see that is if you go to your Schedule 1 of your tax return, and I'm on my way there right now. So if you take a look at Schedule 1, you're going to go down and you're going to see on line 27. Line 27 is basically going to have a deductible portion of the self-employment tax. It's 1/2 of the whatever the tax is. So if you're looking at a tax return, you want to make sure everything looks good. compare line 27 to line 57 of schedule, which is on schedule 4, you're going to see self-employment tax. If you compare that to the number on schedule 1 on line 27, it should be 1/2 of that. Okay, so because what happens is, like I said, as an employer, you can't get a deduction for the tax that you pay. That's the employer's or the employee's responsibility, because you're treated as an employee, but you can't get it for the employer's responsibility, and so that's kind of important. You also have the 3.8 net investment income tax. This is the net tax. We've talked about this as part of the Affordable Care Act that they passed in 2010. This was a tax that was added onto it, and of course part of the reason why they added it on is they were trying to keep it under $1 trillion over 10 years, which I'm not trying to get all the political side, but I kind of find it interesting how government wants to get on. If it's it's $1 trillion, or if it's 999 billion versus 1 trillion, I don't know if it once you get to those level of numbers, does it really matter? But it is what it is. So that was one thing that they did, and then another one they came up with was the 0.9 additional Medicare tax, which is, for all intents and purposes, it's a Medicare tax, and it applies to single people who make more than $200,000 a year, and then for married filing joint, if you have married filing joint income of $250,000 or more per year. What'll happen is that once you hit $200,000 in income, salaried income, your employer is required to withhold it. So if you're single, there's generally not going to be any problems, because they're going to withhold it from your paycheck as it goes on anyways. The problem where we run into with this is usually married filing joint. So you'll have one spouse that makes $150,000 a year, may have another spouse that makes about $150,000 a year. Put together, they're $400,000 or $300,000 a year, and so they're going to get triggered by this 0.9% additional Medicare tax, and so that's where we kind of have to worry about that. You also have tax credits, which are going to reduce tax liability dollar for dollar. Now, this is where I want to talk about this for a second, because this is an important note. Tax deductions are not as valuable as tax credits, and I think this is going to make sense when we explain it. The value of a tax deduction, and we've talked about this with the marginal tax rates, the value of a tax deduction is the deduction times the marginal tax rate. Okay, you're going to reduce taxes dollar for dollar at the deduction times the marginal tax rate. So if I have a chance to buy a piece of machinery for $10,000 and I can fully expense it in the first year, and my tax rate's at 40%, the value is going to be $10,000 times 40%, which is $4,000. That's my deduction that I'm going to be able to take. Now, the tax credit goes to reduce taxes dollar for dollar. Okay. In other words, if I have a child tax credit of $2,000, I don't take that times 40% to figure that out. I take that and dollar for dollar take it down. One of the tricks that ends up happening, unfortunately, in the code is that a lot of your tax credits, they're only going to give you a percentage of an expense that you pay. Very good example is a dependent care expense. If you make a lot of money, you're going to get 20 cents on the dollar. So you pay $6,000 for your 2 kids to go to daycare. You'll get 20% of that as your tax credit. And so what ends up happening is, if you're a high income earner, say you're in the 35% tax bracket, 35% versus 20%, obviously it's not as helpful. But again, once we calculate that credit, dollar for dollar, it reduces your expenses. So we love tax credits as much as we can get them. Okay. They also talk about tax prepayments in here. I'm not going to focus too much about that. It's important. You need to withhold appropriately, and this is actually a big business that I deal with. I have a lot of clients who come to me and they say, Kevin, every time I do my tax returns, I owe a couple $1,000. Well, what am I doing wrong? What am I doing wrong? What am I doing wrong? And what we find out is, oftentimes their withholding W-4 is not filled out correctly, and so we have ways that we can help them with that. And the reason why they want to do it is because who wants to go to their bank account and strike a check for $3,000 to file their taxes every year? That's the purpose of withholding, is that they want to make sure that they get the taxes taken out as the year goes on, so that when they do the final reconciliation, it's not a big deal. Okay, qualifying as a taxpayer dependent, we kind of talked a little bit about this. We didn't talk about the rules. Okay, so if you're going to qualify as a taxpayer's dependent, it's not as important as it was in the past. Prior to the new tax law act that was passed in 2017, this would determine who gets the exemption. And at the last year that this was enforced, it was $4,050 as an exemption. Again, the value of that is whatever your tax rate is times $4,050. Now with the new tax laws, exemptions went the way of the dodo. They're gone. Okay, at least temporarily until 2025, unless they're made permanent under another Congress. But what ends up happening is that that deduction is now gone, so it's not as important. However, it is important for two additional tax benefits that are going to exist. One is going to be your education credits, and the number two is going to be your child tax credit. So, in times where we really talk about this the most are two factors. Number one, divorce. You have two parents, and what will normally happen, and many times my client, what will happen is the man and the woman get divorced. The woman gets to keep the kids, but the man ends up paying something like, $40,000, $50,000 in child support. And so the question becomes, who gets to take the child tax credit? Is it the mother who's, raising them, taking time off work in order to bring them home, blah, 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 so on and so forth, or is it the father who's striking a check for $40,000? 9 times out of 10, this is going to be addressed in the divorce decree, because this is going to be a hot topic of debate between soon-to-be ex-spouses. Who gets to take the tax credits? At least if the divorce lawyers are doing their job. And that's when your clients are going to come to you and say, what do I want to do? Well, if you're going to give up that tax credit, you better get something in return. So you kind of explain that to your clients, and it actually works out better. The second time we run into this, actually, coincidentally, is college students. Because what ends up happening is that college students, you guys want the tax credits that you're entitled to because it's extra money in your pocket. However, mommy and daddy are sitting there thinking, well, wait a minute, we're stroking checks for, $20,000, $30,000 for your education. We want those tax credits. However, what ends up happening sometimes, mom and dad make too much money, they can't get the tax credit. And so there's ways to get around it. That's more of an advanced topic, and it's not really something we would cover in this class. But it is something, and I'm willing to talk offline with anybody who wants to know about it. And I'm sure there's a lot of interest in this class, particularly my morning class. Afternoon class or the evening class, I've got a lot of independent students who probably are like, I get my tax credits because I pay my own tuition. But if you have any questions about it, I'm happy to help out. In order to qualify as a dependent, you have to either be a citizen of the country, you have to be a citizen of the United States, or a resident of the United States, Canada, or Mexico. Okay, and this actually happens a lot in my practice, where the kid is living, say, in Finland, the kid is living in Sweden or Germany or whatever, and the kid and the parents are like, well, I'm still paying out more than half my support for my kid that's in college over in Finland. I understand that, but you don't get to take them as a dependent because they're not meeting this requirement. So that's one thing that you sometimes have to run into. When we do dependency and you're trying to get it, there's actually two major tests. There's the qualifying child test and there's qualifying relative test. We talked a little bit about this in class, but I want to go a little bit more into detail about it. So the qualifying child, there's a relationship test. Has to be one of your, child, stepchild, and there's your book will actually go into more of the details of it. And actually, I don't have to memorize it. And the reason why is because in the software it'll say, hey, which relationship is this person? And then I'll just say, oh yeah, it's their child, so it's their daughter, it's their son. So obviously they qualify. Now, if you've got other relationships that also qualify, but they're run into a little less. The age test. If they're 18 or less and you're in high school, 18 or less, and living at the house, you're golden. You don't have to worry about it. Actually, the house portion is part of the residency test. But if you're 18 or less, it's not a problem with the age test. 19 to 23, you have to be a college student in order to still qualify under this, and that's kind of important. The residency test, you have to live in the house. Now, there's certain exceptions to this rule. For example, there's probably a lot of you guys who are coming here to George Mason who might be coming from out of state. Technically, you still meet the residency test even though you're living in another state from your parents, because you're doing what's called a short-term absence as going to college. So that's kind of the big thing. The last test that they mentioned on this slide, the support test, is where a lot of people get hit the hardest. Because what happens is that who pays more than half the support of the individual that's being claimed as a dependent? If it's your parents are paying half, that they get to take they're the ones who get the dependency exemption on you. If they're not paying more than half your support, if you're on your own and you're basically like, no, I go to work every day, I pay my own rent, I pay my own food, blah, 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 technically you get that deduction. Okay, so and this where this really becomes a big issue is the IRS doesn't question this that much. I mean, I'm not suggesting that we do anything that's illegal or wrong, but usually where this becomes an issue is where the child declares themselves as dependent and the parent says, well, they're my dependent. And the IRS gets both of them and they're like, whoa, one of you is wrong. And we got to figure out which is wrong. That's where they kind of go through these tests. But your CPA, as a CPA, should be doing this with your clients all the time anyways. Then there's also the tiebreaker rules. I'll let you look at that as it goes. Then there's also the qualifying relative. Now, the qualifying relative, there's three major tests. You have the relationship test, which is, you have to be a qualifying relative, is listed under the code. You have to have the support test, more than 50% of the support. But then there's also a gross income test. You have to make less than the required gross income amounts, and I'll put that up on the screen here. It's actually pretty easy for us to get. So if you don't meet those tests, you don't qualify. And that's a gross income test is what kills the qualifying relative so many times. I've told you that I have a client, taking care of his mother. Unfortunately, mom makes too much money, can't take the gross income test. So that's kind of what happens. We talked about the 5 filing statuses. We've already talked a little bit about most of this. Here's the thing that I want you guys to understand about this. If you're married, you have only 2 options. You can do married filing joint or married filing separate. There's a few times that you can do a different filing status, but for the most part, those are the only 2 that you get. You can't be married and claim single unless you have a qualifying event that's causing that. Okay, a very good example is if you're married and one of the spouses decides to run away to another country, never hear from them again, after they qualify for a certain amount of time, they can go to the single, but it's not something that happens on a daily basis. The qualifying widow or widower is something we kind of talked a little bit about. Basically, and I told you about this with my father. This was actually a big deal. My mother died when I was 15. And so what happened is she died in September of 1989. And so for 1989, my dad got to still file married filing joint because the IRS says, hey, look, if your spouse dies during the year, we're going to say that she lived throughout the entire year as far as, claiming her on your tax returns. What will happen is when you file the tax return, you put deceased on the top of the tax return, and then that will actually indicate to the IRS that, hey, this is why we don't have a signature on the spouse's page. And so you get to do that for the year of death. And then if you have qualifying kids, qualifying dependents, you will be able to claim a qualifying widower status for 2 years. And based off of that, you still qualify for the higher tax brackets that you would get otherwise. And so it's sort of to kind of ease the burden for the first couple of years. I mean, I'm going to tell you something. I mean, I love my dad to death, and I'm gonna take this time to brag about it. He'll never watch this video, so I'm not worried about him, me embarrassing him by saying this. I'm so proud of him. For him to lose his wife, I saw how it tore him up. And then to spend, there was myself, there was my 2 sisters, and to be honest, I was 15 years old. I was dumb as bricks. I was driving him nuts. This was when I was, causing a lot of trouble. I wasn't, I was doing a lot of things I probably shouldn't have been doing, and causing him a lot of stress. The last thing he needs is the tax man coming to him and saying, because your wife has passed, we're going to jack your tax rates up. I mean, this is something that, on a personal level, I've seen how this affects people. So I'm just forgive me for a moment of indulgence in there. Single, in order to be able to file single, guys, you have to be single. And that's as of the end of the year. Now, the biggest issue where we run into this is you're divorcing. Okay, when do you get to revert from the married statuses to the single status? And that is, if you are divorced by the end of the year, you are single. If you are married at the end of the year, you're married. That's just kind of the way it is. My wife and I got married, in December. the year that we got married, the IRS treated us married for the entire year. I mean, that's just kind of the way it worked. So it was actually a good thing in that sense. Head of household, basically, if you have a qualifying relative or a qualifying child and you are single, you can take head of household rates, which are more preferential. It's basically the single parent is a very common example that you run into with this. You might also run into this where, you've got the diligent daughter who's taking care of their mom, as I've talked about as some examples in my class. Okay. And the slides that we've already provided you guys have all those examples. Okay. All right, so that finishes chapter 4. Okay, so then welcome to chapter 5. So basically we're going to go ahead and kick this off. And we talked a little bit about some of the stuff in here. Very good example is income. We didn't really talk too much about income. I mean, you guys probably know what income is. I mean, you're accountants. It's not a big deal. But in kind of hitting to more of what the IRS kind of looks at it. I've always felt that income is kind of like love. You know it when you got it. We're all accountants. We understand the concept of income. But the way the IRS derives it is definition of gross income for tax purposes, Code Section 61 subsection A. Gross income means all income from whatever source derived. Okay. If I pay you money because I want to buy something from you, that's income. If I pay you because I want you to do some services for me, that's income. If I pay you to not do something, that's income. Okay. Income is very broadly defined under the tax code. Okay. So it's one of those things that we just, generally if you have any doubt, it's most likely income. But there's certain times when it's not going to be income. A very good example, an inheritance. If somebody dies and gives me something as part of bequeaths me a piece of property, that is obviously not income. That's transference through death. That falls under estate tax more often than not. And then we also have, if somebody wants to give me a gift, if my dad comes to me and says, hey, you know what, son, I'm proud of what you've accomplished, blah, 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 so on and so forth. Here's a nice gift for a bottle of wine of, that cost me $1,000. I mean, that would be a really nice bottle of wine. I mean, but it's technically a gift. Okay. Now, we'll talk a little bit about gifts and estates, not too much, more because this is more of an income tax class. But there's going to be certain times where death and gift is going to give us various benefits and various exclusions that we have to do from income tax. So we're going to have to talk about it. So they talk about taxpayers recognize gross income when there's an economic benefit, realize the income, and the law does not provide for an exclusion or deferral. And they kind of go into the definitions of this. I'm not going to hit this too hard. My personal opinion is generally you're going to know when income happens. I mean, I've never had a situation in the past 5-10 years where somebody's come to me and said, okay, is this income? And I'm like, is there an economic benefit? Is there a realization that's kind of hit with it? That's not the way it works. 9 times out of 10, it's kind of like, I think it's income and this is the reason why. And there's just sort of like a philosophy kind of principle to it. 9 times out of 10, it's probably income. If you got to ask the question, it's probably income, unless there's a specific reason why it's not going to be income. Okay. They talk a little bit about when to recognize income. Individuals generally are going to be calendar year periods. I've only heard of one example where that was not the case, and it's so bizarre, I don't even want to share it because I'm sure someone's going to come to me and share this with somebody, and the next thing you know, I'm getting sued for disclosing something I ain't supposed to be disclosing. It doesn't happen. I mean, like I said, I've only heard it happen. They say individual taxpayers file returns on a calendar year period. I have seen one example where that does not apply. And there's a variety of reasons why that was set up that way. Corporations often use a fiscal year end. That is partially correct. If you're going to see a fiscal year end, it's probably going to be a corporation. Other entities can use fiscal years too. You can use it for a sole proprietorship, technically, although that would be an individual issue. Again, I mean, I'm just talking theoretically because I've never actually seen it. But you could also use a fiscal year for a partnership, although the IRS doesn't tend to like that. But there's certain reasons why you might want to use it. S corporations can use, don't have to use a calendar year either, although the IRS doesn't like to do it, because oftentimes, you know, the sole purpose of the individual doing that is because they want to defer the income. And we'll talk about that when we get into sort of the business tax issues with that. The method of accounting generally determines the year in which the income is realized and included in gross income. That's correct. Okay, so if I earn income at the end of my fiscal year, which happen, you know, so say for example, I'm a calendar year individual, but my partnership, say, is a fiscal year where it ends, you know, March 31st of every year. Okay, we do the Japanese thing, where it ends March for 31st, and then the first of the year is 1st of April. If I earn my income for that tax return period at the end of March, then obviously I'm not going to file taxes on that income until the following year. And you can see where there's an income deferral that takes place if I have income already set up to the end of March 31st. Now, there may be generally good reasons why you want to do a fiscal year like that. Again, it's a Japanese thing. All Japanese corporations run from April 1st to March 31st. That's the typical fiscal year for Japanese corporations and companies. If I am a contractor that I deal with a lot of Japanese companies, maybe I want my fiscal year to line up with theirs. That's a perfectly valid reason to do it, and the IRS would more likely than not agree with that if there's a business reason to do it. They just don't want to hear the reason why. Well, you know, we don't want to pay tax on it until, you know, 9 months later. That's not the answer the IRS wants to hear. So there has to be a legitimate business reason for doing it. Accounting methods, you can use accrual method and cash method. They say, you know, corporations use accrual method, individuals use cash method. That's not entirely accurate either. There's certain, if you qualify for certain, under certain measures, a corporation can definitely use cash method. I've several clients that use cash method that are small companies. S corporations can use cash method very easily. You know, and partnerships can use cash method very easily. You know, individuals will almost never use accrual method, although your Schedule C could use accrual method if you elect to do so. It makes it a little more complicated, so we don't necessarily oftentimes recommend clients to do it, but there could be reasons why we want to do it versus why we would not want to do it. I'm not going to talk too much about constructive receipt because you know, that depends on what your accounting method is. More often than not, when you're dealing with most companies at the small level, you're going to be dealing with you know, you're going to be dealing with companies that are probably on the cash basis. And of course, when do we recognize cash basis income? When I got cash. That's when it gets done. Claim of right. Income is recognized when there are no restrictions on the use of the income. And we talked about claim of right in the class, so I'm not going to hit that anymore. Who recognizes it? You know, this is sort of some more philosophical stuff that we may talk a little bit about a little bit more in detail. Types of income. Okay, something that we didn't talk about in the 3 classes when we were talking with the tax returns, and I kind of want to do it now, is I want to talk about the 3 buckets. Okay. 3 buckets. The morning class we talked about this. The evening class we hadn't hit this topic yet. But the 3 buckets of income. You have 3 types of income that you can have in these buckets. You can have active, passive, or portfolio income. Active income, you know, what they talk about here, they call it earned income. You can have active, well, you have active earned, anyways, I don't want to get into the whole earned versus unearned versus active versus passive and all that sort of stuff. If you go out there and you do wages, that's active income. Okay, and basically what's going to end up happening, if you go out and you know, like I worked at McDonald's for a little while, I flip burgers, I go in, I flip burgers, I get a paycheck, that's active income. Okay. It's generated by the efforts of the taxpayer. Probably the best way to explain that. Income from property, which they call unearned income, more likely than not, it's going to be passive in nature. So, for example, if I buy, let's say I buy a house and I decide to rent it out, that's going to be passive income. Now, it says here includes gains or losses from sale of property, dividends and interest. Dividends and interest not necessarily going to be passive. Okay, more likely than that, they're going to be portfolio income, and that's going to be it. There are aspects to it if you get into other areas of tax, for example, international, where they'll say, hey, dividends and interest is a type of passive income. I don't want you to focus on that, though. What I want you to focus on is that there's 3 buckets. You have active, which, active is going to be when you go out and you actually make your money. You have your portfolio, which is going to be interest, dividends, sales of gains, sales of assets for capital appreciation. For example, I buy a stock today, I sell it later on, I hope to make money off of it. That's going to be a portfolio income item. And then I have passive. Now, passive rental real estate under 469 subsection C is an automatic classification for rental real estate, unless you qualify for an election to get out of it. 99 times out of 100, you're not going to have clients that are going to do that. Probably the most famous person that I know that has that election is Donald Trump, and that's just because he was a real estate Mongol, and real estate professionals get it because if they hit certain criteria. Now, obviously, we haven't seen his tax returns. I don't want this to turn into a politics class. I'm not trying to say one way or the other on that. But the fact of the matter is, I would assume that he probably does because again, this is something he does on an active basis. Another very common one that you'll see with this, though, are real estate agents. They do buying and selling of houses on the side in addition to selling and buying houses for their clients. Okay, so that's going to be a very common example. But it's going to be passive. Now, that's a very common passive income item that you're going to see when you go into the tax preparation business. Take on the side, the passive income oftentimes will also happen through operations of business. And a very good example that I usually use with this is, say for example, you're a real estate agent. And I actually teach a lot of real estate agents tax policies and tax updates, and so I oftentimes use them as examples. So I'm like, hey, you're a real estate agent in Loudoun County, one of the richest counties in the United States, and you got a nephew who finds out that you're a real estate agent, thinks you make all this money, you got more money than you know what to do with, so you want to figure out ways to invest it in order to be able to help yourself out and make some extra money. So you have a nephew who comes to you and says, hey, I've been working at McDonald's now for 3 years. I really enjoy it. I think at some point I'd like to buy one. And you're kind of thinking to yourself, yeah, that sounds like a good idea. You're a bright kid, and they're going to graduate with their degree in business administration from George Mason. Maybe they've got a few years of management experience under the McDonald's. And so what you do is you say, okay, look, I've got $300,000 burning a hole in my pocket. I'll invest that into the company, and what we'll do is we'll form a partnership. I, as the real estate agent, are going to put in $300,000 into this company. We'll say $300,000 just to keep the math easy. You then are going to have your nephew who puts in no cash whatsoever. Okay. Now, some of you might say, can you really form a partnership that way? And the answer is yes, as long as there's economic viable interest. And I don't want to get into that because that's not part of the class right now. But what ends up happening is, when you form this sort of partnership, my nephew's going to go to work every day, flip burgers, manage employees, deal with all the stuff, running the business, blah, blah, so on and so forth. I'm the one who's sitting at home collecting checks. Okay, so from his perspective, this partnership is an active activity. Okay, from my perspective, this is a passive activity. And so what will end up happening is, when I file my tax returns, this actually becomes a passive activity to me, becomes an active activity to my nephew. And we're not going to talk about too much more detail than that. But once we get to that, there's actually 3 other buckets that we have to learn about. And then on top of that, we also have to calculate self-employment tax, because for him, it's an active business. He hits hit for self-employment tax for this stuff. For me, because it's a passive activity, I don't. Okay, this is an investment activity, and so I don't, because I'm just sitting around collecting checks, I may not have a self-employment aspect of this. Unless I decide, hey, I want to work temporarily or on a part-time basis for this, then I could get hit with that. Okay. But that's kind of the role of passive, and we're not like I said, we're not really going to hit it right now. When we get to businesses, it's going to be a major issue. Okay. Okay, they're going to talk about annuities a little bit. Annuity, basically, what that is that you pay a whole bunch of money to an organization like a life insurance company, and they're going to pay it back to you over time, including interest on that money, minus fees that they charge you for it. I mean, annuities come in about every type of flavor that you could imagine. You know, I've seen variable rate annuities, I've seen fixed rate annuities. This is not a financial management class, but I would be careful about using these without talking to a financial provider or a financial professional. Make sure you talk to a financial professional about this. But you may have questions that your clients are going to bring to you saying whether this is a good idea to get into this stuff or not. Again, guys, that's not our swim lane. Our swim lane is basically to only talk to our clients from the tax perspectives and what's going to happen to this. Why do they bring up annuities in a tax class? Because if I pay, say I have my 401k, I have $1 million, and it's a Roth 401k. So what I decide to do is I say, look, within the Roth 401k, I'm going to buy an annuity. And then I want that annuity to pay me a set amount of money every month for, you know, the next 20, 30 years. Okay, so that I can enjoy my retirement. I pay that money, and then I start getting money back. So what ends up happening is part of the money that's being paid to me is earnings. Part of the money that's being paid to me is return of principal. The return of principal is never taxed. Now, if I did this within an IRA, well, technically neither is the earnings. However, if I did this outside of an IRA, not something I'd recommend in this certain case, the earnings is going to be taxable to me. Okay, so I'm going to have a taxable portion of that that's going to take place as a result of the fact that that we have these earnings that are coming out. Okay, so I think that's really where we want to kind of talk a little bit about that. Property disposition. So we kind of talked a little bit about this in the investment class in the morning. Basically what happens is you have two major terms. You have AR and AB. AR stands for amount realized, AB stands for adjusted basis. Amount realized is money you receive minus costs of sale. That's your amount realized. Adjusted basis is going to be cost to buy the asset plus improvements plus cost to purchase that asset minus depreciation can be your adjusted basis. Now, cost to purchase the asset, what is that? So I buy an asset and I have to move it from Pennsylvania to my warehouse here, or my factory location here in Virginia, and have it set up. That's a cost in order to purchase, because I have to get it in order to place it into service. So that's all going to be added to that basis. And then what happens is, in order to calculate gain or loss, you take AR minus AB, and that's your gain or your loss, depending on how things go. We're not going to talk too much about this. In the second section of the class, where we talk about property dispositions, we're going to really hit this hard, and so I'm not going to talk too much more than what's said there. Other sources of gross income, you could have income from flow-through entities. That's your partnerships, your S-corps, and all that sort of stuff. That could come in. Alimony. Up until 2 years ago, alimony was taxable to the recipient, tax deductible by the payer. Okay, that went away starting in, I believe it was 2019. Once you got divorced after 2019, or 2019 going forward, any alimony that's paid to the spouse that's receiving the alimony doesn't pick it up in tax anymore. And some of you might say, well, wait a minute, hold on a second. So if I get divorced and I got to pay my ex-spouse a whole bunch of money, why is it not income to them and taxable to me? From a philosophical perspective, it is. Okay, I don't think anyone's doubting that. The biggest problem that I think I've seen with this is taxability of this. First of all, most spouses don't know that this is taxable income when they first get it, or if they do know, most people are not commonly used to the idea of paying quarterly payments. Okay, so hiring a CPA in order to figure out your quarterly payments every year based on your alimony that you're receiving can get a little convoluted, and I know this has been a big problem for a lot of spouses. I have a lot of wives, ex-wives, not my personal ex-wives, obviously, but wives who come to hire me as their CPA, and they're receiving alimony from their ex-husbands. There's been a lot of times where the whole reason why they're hiring me is because I got to do quarterly payments on them. Other than that, they'd be doing TurboTax. They just don't want to deal with all the other stuff. Okay, but the definition of alimony is actually here on the slide. I'll let you take a look at it and you can figure it out. Prizes, awards, and gamblings. They're excluded only if made for scientific so for example, as I recall, I think Nobel Prizes are a good example of this. They just passed the law not too long ago about the U.S. team athletes from the U.S. Olympic Committee on the account of their competition in the Olympic and Paralympic Games. There are AGI limits that do apply. So if you're Michael Phelps and you make $1 billion a year or whatever, how much ever money he makes with all of his endorsements, when he gets his gold medals from the Olympic Committee because he wins, they're not going to exclude that income from him because they're going to be like, dude, you're too rich, So they're just not going to do it. Okay, so that's kind of where we're at on that. We've talked about Social Security benefits. The big thing about Social Security benefits, up until 1982, they were 100% tax-free. Because the way they thought about it is that you got taxed as Social Security taxes, and then you're going to be given that benefit back. Why would you be paying taxes on something that you actually paid into? Well, that went away in 1982 when they did the Major Tax Reform Act that they did in 82, where they actually made they increased the taxability of Social Security. So if you make up to, and they actually have it here. They're saying for single taxpayers, if it's modified gross income is less than $25,000, it's not taxable. If it's less than, or if it's greater than $25,000 but less than $34,000, then 50% is taxable. And if it's greater than $34,000, then it's 85% taxable. I don't talk about married people here, but I think I've talked about that in class, and I can actually get those numbers for you if that's something you'd be interested in. Imputed income, employee discounts or low interest loans can generate income. So for example, say you're my nephew or niece, and you come to me and say, Kevin, Uncle Kevin, can I borrow $100,000 to go start a business? I'm like, yeah, I love you. You're a wonderful kid. I think you've got great potential. Let me give you $100,000. You can go do it. But you're my family. I'm not going to charge you interest. Why would I do that? That sounds mean and cruel. What the IRS is going to do is they're going to say, whoa, 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 whoa. This is an interest-bearing instrument that you're doing. You should be charging interest on this loan because that's the way it's supposed to do. They can impute that interest and charge me income on it. Okay, as I'm paying that interest. The worst part is that if you don't do a standard market rate interest, the individual who's paying that money back will not get an interest deduction. So this is why when you do business loans with family, friends, or whatever, you still want to set this up just like as a regular loan contract and do market rates, because the last thing you want to do is have a situation where one of you loses some tax benefit that could happen, and the other person has a huge tax hit. That's just you want to be smart about that. Discharge of indebtedness. There are certain circumstances where if you get indebtedness discharged, very good examples, credit cards. I actually had a couple clients who hired me because I don't know what it was. It was like last year there was like a whole bunch of clients who came to me and said, hey, I canceled credit card debt. And I was like, first of all, I had one client who actually had been my client for a couple years, and I was like, you didn't bother to tell me this till now. I wish you would have contacted me. There's make sure that we were doing things right. In his case, he was actually lucky. He just got lucky. It actually ended up working out very well for him. If you get cancellation of debt, that's technically income to you, okay? Because when you receive the cash, there was no tax. Because if I go and I spend $10,000 on a credit card, I don't get taxed on the $10,000 of benefit that I received. I basically bought something that I haven't paid for yet, technically. But I'm on the hook for it. So that's why the IRS kind of comes back and says, okay, well, that's technically just like spending cash. If you go back to credit card companies, say, mea culpa, can't pay it, then they go, okay, we're going to cancel it. We're going to ruin your credit for about 2 or 3 years, but we'll cancel it. Then what ends up happening is that they go, okay, fine, but that cancellation is technically income to you because now that cash was actually given to you for some reason. So the cancellation of debt income, there are some exceptions to it, and they have if you have insolvent taxpayers, if the discharge makes the taxpayer solvent, the taxpayer recognizes taxable income to the rate of the extent of their solvency. This is a very common exception that we do with this. Basically what happens is when somebody comes to me and they say, I got cancellation of debt income, and I'm be like, okay, fine. Bring me all your debt. Bring me everything that you've got. Let's see where you stand. And oftentimes what ends up happening is you have a house underwater. you're like, well, you're obviously insolvent technically by this definition. Ergo, it's going to be a tax-free discharge. Congress also has certain exclusions. Municipal bond interest, we talked about that. We're not going to talk about that anymore. Gain on the sale of personal residences. We didn't really talk about this at all, but if you own your own house and you decide you're going to sell it after you move, there's an exclusion that's available. It's $250,000 for single people, and then if married filing joint, it's $250,000 for everybody, but if you're married filing joint, it's $500,000. You have to have a 2 out of 5 of the 5 last year's ownership test and use test, that if you pass those, it's going to exclude all these income taxes that you would end up paying on the gain of the sale of your house. It's actually pretty good. I've had a lot of times where most clients end up, they own a house for 20 years, they want to sell it, they bought it for $100,000, they end up selling it for $400,000. Gain is completely excluded. It's actually a pretty good deal for them. Fringe benefits, we didn't talk about this, but certain benefits are actually called fringe benefits. Very good example. They talk about here common or medical and dental insurance. We talked about this in class, where there's sort of this balance sheet method that we take with things. If I give you a deduction on this side, you got to pick up income on this side. Health insurance income is actually a very good example of an exception to that. The corporation pays for your health insurance, gives it to you, gets a tax deduction for the cost of that, but when you pick it, you don't have to pick it up in income because it's an exclusion specifically stated under the Congress laws, so you don't have to worry about that. And they kind of talk a little bit about some of the exclusion. They have a chart. We'll skip that. Education-related exclusions, scholarships. If you get scholarships for tuition, fees, books, and supplies, it's an exception that you don't have to pay tax on it. Now, if they give you a housing scholarship, different story. That's a taxable scholarship. Okay, but the exclusion only applies if you don't have to do services in exchange. So this actually was a problem when I was actually doing my graduate students type thing. So what ended up happening is that they came to me and they said, "Hey, Kevin, we're gonna, you're taking 9 credits. We're willing to waive 3 credits for you. And in exchange for waiving those 3 credits, we're going to ask that you work 2 or 3 hours a week in order to justify some of the stuff." And so what ended up happening is certain parts of it ended up becoming income to me. Now, of course, in addition to receiving the waiver of the tuition, I also received a little bit of money on it. So that's why a lot of that worked out the way that it did. Very common for graduate students to have this happen. Not so much for undergraduates. It doesn't happen that much. Another educational subsidy is the 529 plan. Think about the 529 plan, putting money into a 529 plan, there's no deduction, but when you take the money out, it's 100% tax-free so long as, and I'm talking for basis and earnings, so long as the money is used to spend on education-related expenses. You can also do, taxpayers can also elect to exclude interest earned on savings bonds when the redemption proceeds are used to pay for qualified higher expenses. I actually mentioned this in the morning class. I said, how many people have savings bonds? I think I got like one hand. They're not as popular as they used to be, which is actually unfortunate because I think, I remember when I was a kid, one of my aunts, Aunt Barbara, I love her to death. She would, as a birthday present, we'd get in the mail, a $50 savings bond. I'm looking at it, and I'm like 6-7 years old, and I'm looking at something that's got the number 50 on it, and I'm just like, oh my God, it's a lot of money. But of course, what happened is she bought it for $25, then I'd have to wait 7 or 8 years before it would mature, and it would actually double. But that was always kind of neat, and that's how I kind of learned a little bit about money. Exclusions that might mitigate double taxation. There are certain things that can eliminate the possibility for double taxation, one of which is gifts and inheritances. Obviously, if you do a gift to somebody, there's certain treatments that we do with it. One of the things that happens is, actually let me back up and talk a little bit about this. So if you do an inheritance, so say for example somebody dies and they give you a piece of property, and let's say that it's the family home. Family home was built in 1950. It was bought for, we'll say it's $10,000 because it was in the middle of nowhere at that time. Now it's all encroached with, the city. And so the value of the house has actually grown from $10,000 back then plus land, all the way up to, we'll say, 1.5 million. Okay, so obviously if grandma would have sold this house, that is a huge gain that she's going to have to pay taxes on. Okay, so she elected, but through tax advice, decided not to do it, but was going to will it to her son as the family house and make sure that it, you know, goes to him so that he can live in it when he decides he's going to retire. So she dies. The house is worth $1.5 million. When it goes from her estate to him, it is going to now, the basis is now going to go from $10,000 it was originally bought to the $1.5 million of the value. Now, in order to qualify for that, you have to have an appraisal done. This is something that it drives me nuts with clients. Somebody, you know, and normally, I mean, it's kind of one of those mixed things. Sometimes the fact that the client doesn't think this actually gives you more positive feelings. Look, and I don't mean to make a joke of this, but when somebody dies in your family, trust me, like I said, my mom died when I was 15. This stinks. It is horrible, you know, especially if it happens at a very young age. The last thing that you are thinking about as somebody very important in your life has died is, oh my God, I got to go get an appraisal on the property. Okay, now there are certain families where this will happen, and that's because, you know, they're tripping over the body on the way to the bank. That's, you know, that's family dynamics. One thing about this industry that I really enjoy the most, because, you know, you get to meet some really good families, and then there's some families that are like, good Lord, I'm glad my family's not messed up like that. But, you know, we're the tax people. We're the dispassionate ones. We're the ones who want to reach out and, you know, you want to go to your client. You want to say, you know, I offer my condolences. Hopefully, if you've been close enough, they invite you to the funeral. You know, at the very least, hopefully they reach out to you and tell you, by the way, so-and-so has passed away. What am I supposed to do? You know, I have a couple clients right now that I'm scared to get the phone call at some point. So-and-so passed away. I mean, just because they're older. I expect that it's going to happen at some point. And then the question is, what do we do to take care of those clients going forward? You got to reach out to the person, especially, you know, like one of my clients that I'm very worried about, they've been married for almost 60 years. I can't imagine what it's going to be like to the surviving spouse. But as a tax person, my job is to go to them and say, you know, obviously after a period of time, you don't want to go the very first thing that you say, oh, go get an appraisal done. But at some point you want to say, okay, you know, it's been a month. Let's sit down and talk about some tax issues as a result of this. Okay. You know, be somber, be respectful of their feelings, but then also make sure that you tell them the good tax advice. And then they go down, they get an appraisal. Now, the first thing your client's going to tell you is, my house is only worth a couple $100,000. Why would I want to go do this? And the answer is, if you've had the house in your family for a long time, you want to get the appraisal done, because it is, even though you sell it and maybe there's not going to be a gain triggering because you're under the gain exclusion, you don't know if you're going to live in that house for another 10, 15 years, and then that gain all of a sudden goes from being $225,000 to now $400,000, and you didn't do a valuation, so the IRS is going to want to go back to when it was originally purchased for 10. Okay, we have to do that. I think it's a big area of liability if we don't, but we have to take out the best interests of our clients. Now, gifts is a little different. If you have the house that's bought for $10,000, grandmother, 2 weeks before she dies, says, you know what, I don't want this to be inherited. I want to give it to them because of a personal issue, a feeling that they have. What ends up happening is the basis of the house doesn't go to fair market value. It's still the $10,000 that was originally given. And we have the thing that we say in taxes, basis given, basis received. That's what it ends up being. And I've actually had one client in the past that did this. But it wasn't a house. It was a very, very large financial asset worth millions. Okay, and really, really did some damage to his family because he wanted to be the nice guy 2 weeks before he died. He wanted to be the nice person. I want to see the joy in their eyes when they do this. Fine,
there's ways we can do this that doesn't hurt them for tax wise. It's going to be like, look, I hate to tell you, doctor says I'm a month out. Come to me. I want to talk to you about some things. Okay, here's what I'm giving you when I pass. Then you do that, and then there's no harm there. It's actually very interesting. Kind of not to belabor this point, but I used to watch a show called Growing Pains when I was younger in the 1980s. And the grandparents decided, they were living out retirement. They knew they weren't going to live forever, and they decided they wanted to give the inheritance for the kids early because they wanted to see them spend it so they could enjoy watching them spend it. They're like, why do we want to wait till we're dead to give it to them? Not give it to them while they're alive so we can watch them have it. Okay, I get that. However, you might have caused some issues. Now, if it's cash, it's one thing. Cash is not going to be nearly as much of a problem, but if you decide to give a house to somebody, you could really cause some issues. So we want to make sure that our clients are doing the best things. Life insurance proceeds, generally, if you were receiving life insurance proceeds, it's excluded from gross income because what happens is when you pay for the life insurance, it's not tax deductible. And so, like, again, the whole balance sheet, okay, if I pay for something and I don't get a tax deduction, I don't get a tax benefit, I don't get a taxable benefit when I receive it. So that it works both ways, folks. If proceeds are paid over, actually, this is one thing that they do. The third point's really important. If you receive the proceeds lump sum, generally there's not going to be any taxable issues. Okay. If you receive it as an annuity over time, however, there's going to be an earnings component to this that is taxable. Okay, so your clients are probably going to hear, "Oh, I heard by this." I just did it like 2 seconds ago when somebody asked, when they mentioned life insurance. Oh, this is tax exempt. Sometimes they're not going to realize that, hey, if I take this out over time and this is sitting in a bank account earning interest and they're going to pay me the interest on top of it, that's taxable to me. Okay, and so you want to make sure that that gets sort of conveyed to your client as they're receiving these annuities. Okay. Foreign earned income, not a big deal here. I'm not going to talk too much about it. Again, my firm that I work at, we're experts in this area, so we talk about this all the time. 105.9 is the exclusion on your income, and a maximum of 14,826 for employer-provided housing may also be excluded. This is stuff that we deal with all the time. I'm happy to talk about it on the side if you want to know. Sickness and injury related exclusions. Compensation that you receive from workers' comp is excluded from gross income. It's something that they've done. Personal injury payments are associated with personal injury. Awards that relate to physical injury or sickness are for medical costs for treating emotional costs of treating emotional distress are excluded from gross income. Other ones, including punitive damages, are fully taxable. I had a client who got hit with this. They had sued a major corporation, won a huge amount of money, ended up paying 40% of it to the lawyers, which is typical. The bad news is the way they structured it, the lawyers' fees were not tax deductible, so they got hit for the whole amount as taxes. And by the time he got done with it, he ended up only walking away with only about 20% of what he thought he walked away with. I actually feel really bad for him. I wish that the Congress would address this a little bit differently, but they don't. But that's sometimes, folks, it's not about what we it's not what the client wants, it's what the client needs to know. And that's probably the hardest part about this job is I hate to be the bearer of bad news, but sometimes we have to be. So, that's the important thing to do. Healthcare reimbursement. You have health and accident reimbursement for medical expenses are excluded from gross income. So, for example, if I, and this makes sense, if I go to the doctor and I pay to, for example, I pay to have my, as you guys know, I test positive for cancer. When I go have insurance, when I go have my surgery, the insurance is going to cover most of that surgery. In fact, they'll cover all of it because I've got 2 policies that'll be covering it. Not too much of a problem because, it's not going to be taxable to me for the amount that they're reimbursing me for. I think that's pretty illogical. Disability insurance. We won't talk too much about this, but it depends on the type of disability that you have. I have VA disability. I'm 100% VA to permanent total disabled, so all the payments I receive from the VA is 100% tax-free. Social Security disability does not receive that same thing. Okay. If you have if an individual purchases disability insurance directly into disability benefits are excluded from gross income, if the employers, so for example, you work for a company, you can individually purchase disability insurance for yourself, and if you get that disability money, you then get to exclude from income. Okay. If your employer purchases disability insurance, however, and you use that disability insurance to cover income that's lost, that is taxable to you, because basically the way the IRS is saying is that instead of being paid wages from the company, you're being paid disability payments, and then you didn't make the payments for that disability insurance, your company did. Okay, and again, the company gets to deduct that as an ordinary necessary cost of business, but then when it's paid to you, you have to take it as taxable. Deferred provisions, we're going to talk a lot about these later on in property, so I'm not going to worry about them now. All right. Okay, folks, now we're going to go to Chapter 6, which is individual deductions. So we kind of talked a little bit about some of these, but we're going to kind of hit these a little bit deeper dive. So 3 categories for deductions for AGI. There's directly related to business activities, indirectly related to business activities, and subsidizing specific activities. Yeah, I'm not going to make any modifications to that. I've got a little problem with some of the wording on it, but I won't go there. So directly related to business activities. So as you will take a look, there's a form called Schedule C. If you want to take a look at that while we're kind of talking a little bit about the tax provisions, we can do that. For Schedule C, obviously, if you receive any income, that's going to be your on your line. That's going to say business income received, and then there's going to be a certain amount of expenses that the IRS typically runs into. Very good example: rent, office rent. That's a very common business expense that all businesses have. Auto expenses. That's a very common business expense. Advertising is a very common business expense. Cost of goods sold is also going to be a very common business expense. So obviously that's going to go on there. Well, that actually gets special treatment, so that's why it's up where it is. Then there's certain expenses that are going to be related solely to specific industries, and that's why if you take a look on the back part of a Schedule C, you'll have other expenses. Basically, and we're not going to talk about this too much till we get to the business section, when you get to take a business deduction, it's going to be in Code Section 162, which is what and sometimes I call these, and this is just a me thing, it's not necessarily what they do in the industry. I call them 162 activities, which basically means it's a business. Okay, so you're dealing with businesses here. Under Code Section 162, if it's ordinary necessary to the business. So, for example, if you are a model and you are going to go out there and you're going to have photographs of yourself taken so that you can sell products, if you're a makeup model, if you're a hand model. I actually have one client that is a voice actor. So there's certain things that you're going to be able to deduct as a model and a voice actor that I as a CPA can never deduct. For example, if I want to go down, I want to get makeup done on my face as a CPA, the IRS is going to come back and go, no, not allowed. Of course, I like the way I look anyways. I don't need makeup. I'm good. Although I've had a few people that when I've taken some of these videos are kind of like, Kevin, you probably need to, especially with like this side where there's a lot of lighting on it. They want me to kind of dim that down a bit, but it's not ordinary necessary to the business, so I don't get to do it. However, a model probably isn't going to be able to deduct, a calculator cost. So they go out and they spend $400 on a calculator. They're going to be like, "Your model, why do you need a calculator?" So that's kind of how that sort of works out. And there's, I've worked on some business returns where I'm kind of like, wow, ordinary necessary for you is way different than what some of these other people have to deal with. And so, they talk about, what is directly related to business. They're allowed to direct, anything that's done to directly generate that income. And so now something that we oftentimes deal with is that sometimes people are involved in more than one activity. Very good example, I have a client who's a real estate agent, but she's also a phenomenal photographer. And so she also does some photography on the side. So when realtors will hire her to come in and take pictures of the house. so that they can pin it up. And she's very good at it. So she knows what she's doing. And so she'll come in and do all that sort of stuff. And it's actually really cool because she's my real estate agent. And so, you know, like for example, we're thinking about selling this house, and one of the things that she's going to do, she'll take pictures, and luckily she doesn't have to hire somebody for that. So it's actually kind of cool. But it is some time, you know, something that she'll be able to take some deductions on, because she'll be like, I had to spend, you know, maybe they had to do, you know, not that they do this anymore because all of it's digital, but if they had to spend money on film directly related to her real estate sales activities would be deductible on her real estate business. But if she's going out and taking pictures for another real estate agent, it goes under her camera business. So that's sometimes something that gets a little bit convoluted, a little screwy a little bit. But I think after you've done a few years of this, it's become second nature. There's not much to really worry about. They also talk a little bit here called investment activities. What they're talking about with investment activities is, you know, so if I buy a piece of land and I'm going to go, I'm waiting for capital appreciation, you know, that's an investment, capital investment. It's a portfolio investment. But you can also have investment activities that are, you know, talking about other different types of things. You know, say for example, you know, and I use this example in class. Maybe I do coin collecting, and I do trading and selling of coins, and that's my primary line of business. That technically becomes that. Now, step back for a second. What does this all mean? Why am I bringing up these two types? There's a way. Okay, let me back up. When we are talking about a business activity, there's certain activities that are going to be done that you're going to see as more like portfolio type. And then there's other going to be activities that you're going to be like, no, this is definitely not a portfolio type situation. Very good example is stock and bonds trading. We talked about in the previous section. If I do stock and bonds trading, you know, I go out and I buy a stock and I'm hoping it appreciates, you know, you know, I hope it appreciates in value, and then I go ahead and sell it. It's a capital gain. Now, what if I don't do this, just an investment on the side? Now I'm a day trader. Day traders oftentimes run the risk that their trading activities are not investing, buying and selling for capital gains, appreciations. This is their full-blown business. And then that can end up being an ordinary business where they're going to have to pay self-employment taxes on it. Now, they're also going to get certain deductions that they wouldn't get otherwise. But, you know, so it's always kind of like, you know, how do we want this to work in the best interest of the client as the law allows? So that's kind of how we end up doing some of this stuff. You know, another example, what if I'm a clock collector and I buy and sell clocks, and I'll buy a clock, and then maybe I buy a clock in Switzerland, I bring it over here to the United States, it's more valuable over here, I sell it. That's technically a business. That's not me getting into the investment activities. So there's a lot of gray that sort of happens in that area. It's not binary, it's not ones and zeros, but you might have some 1.5s, 1.4s, or whatever the gray version of the binary is, that we kind of have to deal with. Trade business expenses must be connected to the business activity, ordinary necessary to the activity, as we talked about, and it's claimed on Schedule C. Okay, that's if it's a business. Okay, that's not. Now, there are some things that rise to the level of being a business that that don't rise to the level of being a business that will not be reported on Schedule C, but will instead be reported on Schedule E. So on the next slide, basically what they have here is I like how they kind of break this out in Exhibit 6.1, obviously up on the screen. So for the individual business and investment related expense, what they're considering, and what this slide's really trying to get to you here is, what are some common deductions that are allowed, and where do they go? So for example, if you have business activities, what sort of business activities are, what kind of income is it? And then of course the deduction type. Now you'll notice that there's no deductions allowed as itemized deductions. Now, what is the difference? It says deductions from AGI. Again, I hate those words. It's below the line deductions, okay? So what kind of deductions are going to be below the line for a small business activity? And if they're business related, they're not going to go on Schedule A. That's the whole point. That's why when we have a client who has a small business, a very common sort of desire that we all have as CPAs is how much of this can I put on Schedule C instead of Schedule A, because if I put on Schedule A, it's less valuable than if I put it on Schedule C. Things that are non-deductible, unreimbursed employee business expense. Now, that's related to the employer, not to the employees who work for the company. So, I mean, they're not deductible by the employees anymore either. But when I first read that slide, the first thing that went to my mind was, hey, well, of course, our unreimbursed employee expenses are no longer deductible. Of course, they're not deductible because the employer would get to take the deduction on Schedule C. So that's kind of something that when we're kind of looking at this, I mean, I don't know why they put it this way, but I mean, like I said, as a CPA, as a tax preparer, the first thing that I'm thinking about when I'm got a client that I'm dealing with this is that, hey, how many of these expenses can we get on Schedule C versus Schedule A? Now, some of you might say, well, it says here NA, so anything that's business related can't go on there. Well, there's certain things that you're going to have that might have a dual purpose. Very good example is your house. If I use part of my house as a home office for the benefit of the business, it has to be for the benefit of the business. But if I use it for the purposes of the home, there are certain expenses that are going to go on Schedule A and C that are going to have to be what we would call bifurcating. And by the way, if you haven't heard that word before, that's what we call the $3 word in accounting, bifurcate. Basically what that means is just to split up. So what's going to happen is that we're going to have to determine, based on the home office size versus the home size, how much of the normally deductible deductions under Schedule A for the personal home are actually going to be apportioned to Schedule C. And then there's also going to be some deductions. Very good example, utilities, home insurance, and other things like that are not going to be deductible by the person on their Schedule A, but still could be deductible on Schedule E or C. So we want to make sure that we get that done, and that's actually accomplished using a form called Form 8829. That's Form 8829, and that's what we typically use when we've got a person with one business activity, one office that's used for that business activity. Now, some of you might say, well, gosh, what happens if we have more? And there's various things that we can do, but that gets kind of really advanced as to how we can do this. Another problem that we sometimes run into is, what if the person's got a corporation? Well, the corporation, first of all, if it's on an 1120, that's a separate entity. So what would end up happening is you'd have to have a contract between you, the business owner, you, the owner of the corporation, and then the corporation itself, in order to have part of your home as rented. And then there's various tax ways that we can handle a lot of the stuff that happens with that. If you have a partnership, and say you got go back to the McDonald's partnership. Maybe what ends up happening is that my nephew, that I want to help him open up the McDonald's partnership, he tells me, hey, Unc, I want to go ahead and I want to have I want to have my home office, instead of renting out a business that I can actually have where we run a lot of the business activities that I don't want to do on site, I'm just going to run those out of my home. So what we would end up doing is we would say, hey, look, go ahead and set up a home office, and then what we're going to do is that we will pay you rent for a portion of your home office, and then what will end up happening is then you collect that income as rent income. Sometimes this is what we call income shifting, and it's a technique that can be used by CPAs, where what we end up doing is, what we're trying to do is we're trying to, in that case, we're trying to get the deductions in order to use the home office, but more importantly, to my nephew, income that's received from the business is self-employment taxable. Income received as a rent is not self-employment taxable, and it's because rental activities are by definition not self-employment activities. They're passive. Passive activities are not self-employment activities. So what ends up happening is that we then tell the what we do is we set it up in such a way that he gets to be able to take that income out as rental income instead. So it can actually be a very tax efficient strategy. It's something that I've done in the past. I actually have about 3 or 4 clients that we do this with currently, and it's a great way for them now. In some of the cases, it's the only way that you can do it, because, like I said, if the business that you own is an S corporation, you can't do an 8829 on an S corporation. It's not permitted under the rules and the regulations. Getting back to the next slide, trade or business expenses must be directly connected to business activity, ordinary necessary to the activity, and reasonable amount. Now, this reasonable amount comes up a lot with many of my clients. I think one of the things that I always like to use as the example, I notice that a lot of AICPA conferences are in Las Vegas. And I don't think that's about a coincidence. It's a way for, you to be able to go to Las Vegas, have a lot of fun. Obviously, it's a place where adults can go and have a lot of fun. At the gambling tables, really good food, some of the good shows. But at the same time, you do have a business purpose for going there, because, if you go to the conferences, you're probably picking up about 40 or 50 credits in CPE, which in many states is a year's worth. It's something that it's very beneficial in order to get done. So there is a business purpose for you to go. Now, does it hurt that you have a little fun? No. Is the IRS going to come after you for having a little fun? No. Now, there is some forms of extravagance. If I'm going there to go get CPE that gets done, and I decide to rent the presidential suite, and every single meal that I have is, $200-300 a meal per plate, the IRS is going to start asking questions about, okay, you went to this conference, the average person who spends on this conference goes, $5,000 to $10,000 max, and you spend, $40,000. They're going to start asking about some extravagance that ends up happening with that. And I want you to understand something that's very important about that extravagance rule. It doesn't apply just to businesses. It applies to pretty much any other type of expense that you're going to be able to take. So, for example, and I've used this as a talk when we talked about medical deductions. Where the person decided that he was going to build his own swimming pool because his doctor gave him a note that said, hey, you got to do swimming in order to maintain health based on some medical conditions that you have, which is perfectly legitimate. However, the individual decided to use marble flooring, and I can't remember if it was gold railings or if it was, extremely expensive spun brass railings or something like that. I mean, this guy went all out, and he tried to say, yeah, and I can't remember what the number came up to. I think it was like $50,000-$60,000, which for a pool is really high. I mean, I think the last time I heard, when we were pricing how much pools would cost, we were looking at anywhere between $10,000 to $15,000 for a baseline pool, and then if you went a little bit higher than that, you could talk about $20,000 to $25,000. But generally speaking, that $50,000 to $70,000 for a pool should not have happened, and so he got denied the deduction. It doesn't just apply just to businesses; it also applies to other activities. So be careful about that when you got your clients that are going out there. Expenses claimed on Schedule C, revenues from the same activity are also reported on the same Schedule C. So what ends up happening is we really didn't take the Chapter 3 in tax planning, and part of the reason why I said is that because your first few years in tax preparation, you're not going to be doing any tax planning. In fact, in my personal opinion, it's not really until you get to be a supervisor, tax manager, that you're really going to be doing a lot of that. And so that's where I think you should be focusing on tax planning. Now, that said, as a staff, it doesn't hurt for you to have a good understanding as to what is the most valuable deductions. And so, when they say, revenues go on the same Schedule C, well, that's obvious, right? It's like an income statement. You're going to put revenues on the top, and then on the bottom, you're going to have expenses. The net, and one of the things that we talk about with the value of deductions, the value of the deduction is whatever the expense is times the marginal rate. Okay, so if the individual is in the 22% tax bracket, they are going to, you're basically, what's going to end up happening is that you're going to subtract out 22% of that expense in order to figure out what the value of that expense is. So, good example, I decide that I'm going to go purchase so actually, for example, I'm going to go buy a house, and my mortgage every year, we'll just say it's a flat rate mortgage that's, expense only. That way the principal doesn't change, so the expense doesn't change. So for the next 10 years, I know it's going to be $20,000 a year for my house. You want to know the value of that. What's your marginal rate? So 22% times 20, you're talking $4,400 per year is your value. here's the thing that we have, is that if I have a choice to make about certain things, obviously the income tax benefit is going to be of value, but here's the thing about Schedule C businesses. You're also subject to self-employment tax on that, and that's a flat 15.3% up to the statutory maximum for Social Security. So if you think about it, 15.3% plus 22%, you're looking at about 37.3%. Plus, if there's any additional taxes that you might be thinking about along the way too. So with that 37% as a deduction, now if I go out and I buy something and it costs $10,000, really I have to subtract $1,730 from that. Okay, so that's actually the true cost of my item that I'm buying. And so that's when you can use taxes to your advantage to kind of go back and say, look, yeah, I'm going to go buy something, but this is how much it's really going to cost me. Another good example where we run into this with people is they'll say, hey, I'm trying to figure out if I want to get health insurance for my wife's company, or do I want to get health insurance through me going out and purchasing on my own through my business. And there's buying health insurance is a whole host of factors. Number one, quality. Maybe my wife's company's health insurance stinks. And so what ends up happening is I can go out and buy a much better policy. Now her company maybe doesn't pay for a whole lot of that. I remember I was going to go work for a company before I decided to start on my own. They wanted to offer me health insurance where I was going to have to pay 50% of the cost. It was huge, and then I looked at the policy, and it really didn't provide a whole lot of protection for anything. So I was very unhappy with what they were offering. It sounded like to me they were kind of placating to me a little bit, and I don't know. It was kind of funny actually. I turned down the offer, and they came back to me and said, "Yeah, can we change your mind?" I'm like, "No, I mean I don't think that you've shown me anything that's indicated that I'm valuable to you and as a person." So. Again, there's qualitative factors and then there's quantitative factors. The quantitative factors, of course, being price is the biggest quantitative factor. So if my wife is going to spend, say $400 a month on insurance, 400 times 12 is $4,800. But if I can buy health insurance that, it's going to be hard for me to buy health insurance that's going to be cheaper than what my wife can get from her company. But at the same time, if I can go out and get that health insurance and I can get it actually at a lower cost because of the tax savings, then it ends up working out well for me. Now, we haven't talked about this yet, but with health insurance, there's kind of a little funky thing about that we'll talk about later on. But I'll get to that later on. I don't want to drag this out anymore. So revenues from the same activity are also reported on the same, as we said. The net income from the activity is on Schedule C, line 12. Then it is also combined with other forms of items on page 40, line 1040, page 2, line 6. Now, these schedules they're all brand new. First of all, and I'm just going to kind of break this out to you. I'm not going to expect you to memorize what stuff goes on which schedules. If these schedules were around for about 5 or 6 years and I was pretty comfortable that they weren't going to change all that much, I might, but I've actually heard that the IRS isn't happy with the 6 schedules, so they're actually going to consolidate and bring them into fewer schedules. I think 3 is the number that they're shooting for, but I haven't seen the 2019 proposed forms yet, so we'll take a look when that happens. But I mean, the way it kind of works is that it goes on the schedule and then it ends up on the actual tax form itself. And so, okay, so the next slide, rental and royalty expenses. We kind of talked a little bit about this in the class, but we didn't really deep dive into it. Basically what happens is, so rental and royalty. So royalty, for those of you who don't know, royalty is basically income that you receive when you allow somebody the rights to do certain things on your land. So for example, a very good example of that would be, I mean, when I grew up, I was actually a big Beverly Hillbillies fan, and I'm talking the 1960s version. I'm not talking, I mean, the 1990s movies were actually pretty good too, but the 60s movies were really good. They said, let me tell you a story about a man named Jed. Poor old fool couldn't even keep his family fed. And one day he was out shooting for some food and bang, next thing you know, up comes a bubbling crude. What ended up happening is he accidentally shot the ground. Next thing you know, he discovers oil. So what he does is that he goes to one of the oil companies, basically says, hey, I have oil on my land, go ahead and pull anything that you want off of this, and just pay me, based off, pay me royalties off of whatever you pull from this. And the oil companies make money off it. He makes money off it. Next you know, he's a millionaire and he's moving to Beverly Hills, and that's why they call it the Beverly Hillbillies. But so what would end up happening from a tax standpoint is that Jeb would actually fill out a Schedule E and report all the expenses, report all the income that he received as royalties. Now, some of you might say, well, wait a minute, if all I'm doing is striking a check and collecting a check from the oil company, what expenses do I normally have? Well, there could be several. Maybe I need to travel to my land to go check it out every now and then. Make sure that what the oil company says they're doing on my land actually is what they're doing. Maybe I have to hire a manager to do this. If Jeb's in Beverly Hills making millions of dollars sitting around breathing, chances are he could probably hire somebody for $40,000-$50,000 a year that their whole job is to go check out the property and make sure everything's looking good. Another expense that could end up happening are the taxes. I'm paying taxes on this land while it's being used solely for this royalty activity. That's a deduction. Okay, so there's a lot of deductions that Jeb could take from all this when he actually does all the things that he's going to do. And so we want to, it needs to be examined. Oftentimes when you're going to run into royalty, though, in this industry, it's often because somebody's authored something. I've actually had a couple clients who, they write books. And they sell the books. The books go on to Amazon. They get money from it, and then what ends up happening is they'll get speaking engagements as a result of writing the books. They've got it sort of comes around this now. The royalties that come from the books itself is a separate activity from the speaking engagements that ends up happening because he's being invited to speak about the book. What ends up happening is you have to treat those as two separate activities, and that's what I've done in the past. It ends up being an interesting sort of set of circumstances to take a look at. I have one client. While I was telling the story, I was actually thinking about him. I actually feel, heavy hearted. He came back and told me actually before his book got published, he's got cancer. So now I'm actually kind of thinking about following up with him, seeing how he's doing. But the last time I spoke to him, which was about 3 or 4 months ago, prognosis was great. He was going to do chemotherapy. Everything was going to be fine. And I'm sure that if something had happened, another client that actually is with him would have contacted me and said something's wrong. So I'm not worried about his health as far as his life, whether he's alive or not. But more importantly, is he just how's he doing in general? But he's an individual who he did spent a massive amount of time researching to build this historical novel, and so when it gets sold, he's being told by his publisher he's probably going to make some change off of it, and so he wanted to know how the taxes go on it. And so these are some of the things that we discussed with him when it happens. Rental is probably the most common reason why you're going to use Schedule E, though. You're not going to see royalties as much as rentals. The rental, so for example, somebody goes and they buy a house, and this actually happened to me when I was in the military. I bought a house in Florida, got orders, was told I was going to move somewhere else. Well, I had two choices. I could either sell the house or I could turn around and rent it out. And I decided to turn around and rent them out. That way I could actually build a nest egg for myself. So what ends up happening is I get rents. Rents are reported on Schedule E. And then from that, there's certain deductions that you end up getting. And you can take a look at a Schedule E and see what those deductions are. Okay, so health insurance deducted by self-employed taxpayers. We talked about earlier. We're going to talk about this in greater detail. And here's the way it kind of works. Deduction provides equity that employees receive health insurance as a qualified fringe benefit. Insurance must be provided for the taxpayer who are not eligible for an employer-provided health insurance. So what does this mean? So the first deduction is basically that says, hey, look, if I own a company, and it's a Schedule C company, and I hire 10 people to come work in my company. Well, as a fringe benefit for those individuals, I say, I'm going to cover your health insurance. And, I'll buy health insurance that's $15,000 a year. We're going to put it, and it's going to be covered by the company. You don't have to worry about it. So you go, so that $15,000 is a deduction for me on the business end, and on the employee end, there's no pickup as taxable income, because they've received a benefit from the company. And if you think about it, big balance sheet's kind of being violated here. What's happening is I get a deduction from my business. The employee should be picking it up as a benefit. However, Congress kind of intervened and said, you know what, this isn't fair to the individual employee.
we're going to go ahead and we're going to make it not taxable. Now, what does that mean? If my business buys insurance for me and it provides it to me, those insurance premiums that are then attributed to me are not includable in my W-2, and that's the way it should be. Because again, if you're not being taxed on something, you shouldn't be getting a tax deduction on the other end. Bullet point number 2: insurance must be provided for taxpayer dependents who are not eligible for employer-provided health insurance. This is a very sorely misunderstood part of the tax law. I see multiple times where CPAs are granting tax benefits to people who are not entitled to them. And part of the reason why they're not entitled to them is that, their spouse works for another entity that can provide employer-provided health insurance. A very good example that I see with this is military spouses who actually do side work. The military lifestyle is very, very, very tough. I mean, once every 3 years you're moving, and so at least that's the way it was when I was in. And depending on what job you have, it could be once every 2 years. It could be once every 4 years, depending on your career path. What ends up happening is that if you do your so if you have that insurance that's provided to you by the military, your spouse can't run out as a part of their side business that they have. They can't run out and go buy insurance on the side and say, okay, well, then we get the full deduction off of this, because the way the IRS is going to look at it is, look, you've already got health insurance for your family. You don't need additional health insurance for yourself, so you're only doing this for potentially tax savings. Again, I don't buy the logic. This is one of the areas I do disagree with the IRS on. In my opinion, is that taking this kind of blanket rule, you don't know what the other person's got. Maybe the health insurance that's being provided by the employer is a joke. They're just providing health insurance for the sake of providing health insurance, and they're not really providing a whole lot of adequate coverage. I've seen that happen. I mean, I'm a disabled veteran, so I get the veterans health insurance. So technically, if I go buy health insurance, the VA, they're going to come back to me and say, look, the VA is providing you with health insurance already. You don't get a deduction for this because you've already got health insurance. Why do you need more health insurance off this? Well, the problem that I have with my health insurance is that in order for me to I have to drive to the VA medical center, which is, it's easily a 30-40 minute drive. I got to take half a day off minimum, plus deal with all the paperwork and stuff that a typical VA hospital has to deal with. It's very impractical for me to go do that. Sometimes it's better for me to have health insurance and then go down to the local doctor that's only 5 minutes away and get my stuff done, then go back to work. So I'm not necessarily buying that health insurance for a tax avoidance benefit. I'm doing it because actually it benefits the company. There's no exception to the rule for that. So this is actually one of the areas that if there's going to be an area that I ever advocate for as a change in the tax law, this is going to be one of them. Because I've just seen where veterans kind of get the short end of the stick on this one, and it's not really fair to them. But in addition, it's also it doesn't even have to be military or veterans. Right now, again, I own my own company, but my wife has, full-time health insurance from her employer. Technically, because I can get health insurance from that employer, I don't have to, according to the IRS, I shouldn't have to go out and buy another health insurance. Again, you're kind of taking a blanket rule and saying that all health insurance is equal, and it's not. The health insurance that her company may provide may not be that great. I've always said that health insurance, and this is where I've kind of made an advocacy that I've thought, one of the benefits of having health insurance is owned by the business. I can use it as a benefit to my employees to attract greater talent to come work for me. So, for example, if and this is me, I'm taking off my CAP hat and putting on my HR hat. When I used to be an HR officer, one of the things that we would oftentimes talk about is the benefit package that we're going to offer to people. You want to make sure that benefits package is juicy to those individuals, so that what ends up happening is that they then can take those benefits and see them as a form of compensation. It's what we call the total rewards program. Not only is it cash, but you're also talking about health insurance, 401k, all that stuff. You want to make sure that your
benefits package is better than the competition's, because if you do, then the salary that you have to offer to said employees in order for them to see a total benefit is lower. And sometimes it can actually be better, for everybody involved. There's ways to work around this, and I think that by the IRS having this role, it's again, I know I'm not supposed to be doing a whole lot of advocacy here, but this is just one thing that just sets me off. And I've had a lot of clients that they've had taken in the shorts as a result of this. It's not fair. Now, is there a way around this so that as a business owner, I can have health insurance that is deductible by the IRS while my wife still has health insurance? The answer is yes. And usually what we'll end up doing is we'll end up electing a C corporation status in order to be able to do that, because owners who work for the company that's a C corporation are treated as employees just like everybody else. And so there's definitely some advantages to doing that. It's probably one of the few reasons why C corporations haven't gone the way of the dodo, even though they've got a horrible tax situation in many other aspects. That the greater of the costs, the savings that can end up happening in one area doesn't get hurt by the other. So that's when it's working out. Penalty for early withdrawal of savings. What ends up happening is you can reduce the net interest income to the amount actually received. So, for example, if I have a CD and it's a 10-year CD, or not actually a 10-year CD is unrealistic, a 5-year CD maybe, it was probably the max that you would see. And 2 years into it, I need the money because I've got an emergency. So they said, okay, well, we're going to give you this, but we're gonna charge you a cancellation of an early withdrawal penalty, a cancellation of CD penalty. What ends up happening is that cancellation of that ends up becoming a deduction that I can put on the front page of the return, which is actually very good. Self-employment tax deduction. Again, we kind of talked a little bit about this in the class. As an employee, you have to pay 1/2 of what we call self-employment taxes, back up on that. As an employee, you have to pay 1/2 of the employment taxes. Okay, so the employment taxes are Medicare and Social Security. Social Security is 6.2% charged to you, 6.2% charged to the employer. Then you have Medicare tax, which is 1.45% charged to you. Then you have 1.45% charged to the employer. Put together, it's 15.3%. Individually, it's 7.65%. And so what ends up happening is, when you have a business, you're not an employee, you're the owner. Okay, but you're making money, and so the employer and the employee side still has to be paid. Again, like I said, the IRS doesn't go without. The IRS says that we're supposed to pick up this money, and so because you're the owner and you're not technically an employee, you're going to pay your portion and the employer's portion. Well, the employer's portion is an ordinary necessary cost of doing business, so you get to take that as a deduction on your taxes, and so it's not going to be a reduction of your total tax liability. It's only a reduction of your income tax liability. And if you think about it, it kind of makes sense, because if I gave you a reduction of it as part of your self-employment tax liability, it creates a circular effect which would never end. So we want that to only go against the income tax liability for that reason. And so that's why you'll take a look at it and you'll see that there's 1/2 of the self-employment tax is actually deductible. Deduction for interest expense on loans used for qualified education expense. Okay, so we talked a little bit about this in class. There's 2 areas I want to talk about this. And obviously, we're going to talk about the interest, but we're also going to talk a little bit about cancellation of debt, because I think it's a good tie-in for it. So when you graduate from college and you have student loans and you're going to go ahead and pay off those student loans, what ends up happening is that you're going to pay interest on those loans. The IRS will allow you to deduct, or Congress will allow you to deduct, up to $2,500 of interest on the educational loans if you fall under $140,000 joint, $70,000 of AGI individual. Okay. If you're above that, it starts phasing out until you hit $85,000 for single and it's $170,000 for joint. This is why, I always find this very fascinating, because it's almost like we want you to go to college, go get your degree, but then when you graduate from college, if you make too much money, we're not going to let you take any of the deductions for the interest that we wanted you to go do it. Congress still gets the higher tax rates out of you because you went out and got a higher job. Okay, so I mean, my personal opinion, it should be all deductible. But again, you know, I'm a little selfish in that sense that I'm saying, hey, look, as an individual, now for me, it's only been limited in a couple of years, but I have a couple clients. One's a dentist and one's a doctor, and they're married, and you know, they don't get this deduction. Why? They're making way more than $170,000. Now, some people would say, well, they're making more than that, they should be able to afford it, and that's not the case. That's not the point. The point is that in tax theory, you know, there's a deduction that's afforded to people because of the fact that, you know, this is a societal benefit. You know, if they go out and they make more money, they pay more taxes, and it's sort of one of those things. But anyways, again, sorry for being on my soapbox. It's that time of the day that I'm on my soapboxy kind of person. Exhibit 464, they have the summary of that. We'll go ahead and pass. So now we're going to transfer from deductions for AGI, in other words, above the line deductions, and go to deductions from AGI, which is below the line deductions. Again, moving from above the line deductions to below the line deductions. What does it mean by below the line deductions? It means we've already calculated what AGI is, and now we're going to start looking at what we call Schedule A deductions. Okay, so medical expenses at the top of Schedule A, and we talked a little bit about this. I'm not going to hit too much on this. The one thing I did want to talk about is the personal use of automobiles. We didn't hit that in class, but it is something that I think gets overlooked a lot. Now here in the Washington, D.C. metro area, it's not that much of a critical thing. A very good example, my office is in Herndon. Many of my clients are in Herndon. Right next to Herndon is the Reston Medical Center. I mean, you know, if you're going to take mileage, it's probably going to be at most, you know, 100, 200 miles at the most. You know, I mean, that's if you're going to the doctor on a frequent basis, and it's only 20 cents per mile. So if at 100 miles, you're only going to be able to take $20 as a deduction. Is that really worth, you know, all the tracking with it? And I would say the answer is no. Some of you may end up working outside the Washington, D.C. metro area. A very good friend of mine who lives in Oklahoma. In order for him to drive his mother to the medical facilities, it's 50 miles each way. And she has to do these appointments weekly. Does it make sense for them to? I mean, that's 100 miles a week. You know, 5,200 miles per year if they're doing it every year, including the two weeks at the end of the year for the federal for the holidays. You know, 52 times 20%. I mean, that 20 cents. That's a lot of money. And in his case, he's retired, even though his mother's still alive and he's taking care of his mom. So his money that he makes every day isn't all that much anyways, because he already owns his own home. All of his expenses are pretty much taking care of himself, and then going out and flying and seeing his mom all the time. That's a deduction that he could qualify for on his taxes for doing that. Now, his mom could probably qualify for it if they were using her car. You know, I think he has a second car that he just owns there because he goes there so frequently anyways. But it's one of those things. So, you know, it might be useful, it might not be useful. I mean, here in the Washington, D.C. metro area, the only time that I've ever seen it really work out is if you've got somebody who's in their 80s and they're trying to figure out what's going on with all that. Hospitals and long-term care facilities is another deduction. You can actually deduct all of that stuff, and then there's the limitation is limited to the amount of unreimbursed qualified medical expenses paid during the year, which is reduced by 10% of AGI. This actually, we talked about it in the class. I actually showed you a copy of 2018. So 2018 is the last year which you would get a 7.5% floor on your deductions. It's actually going to go to 10%. Now, when clients asked me about this a couple years ago, they said, what is the likelihood you think it's going to stay at 7.5%? I said it's pretty high, because I can't imagine a congressman going out there and basically saying, yeah, I voted to keep it at 10%. I mean, I don't understand why this isn't a major issue right now, because well, here we are, we're only about a few months away from the end of the year. I think this is going to hit, and I've said this in class, the people who get hit by medical expenses, the deductions the most, are senior citizens. I'm actually shocked that the senior citizen community isn't making, you know, a whole lot of stink about this, but you know, maybe they will once they, you know, maybe it's because they haven't filed their taxes yet and they're kind of like, whoa, wait a minute, this went from 7.5 to 8, you know, 10%. We'll see. I mean, maybe it works out, maybe it doesn't. Taxes. This is also something that I did not expect to last very long, is this $10,000 maximum that we talked about in class. And I kind of told you the history about this, where initially the House version of the bill had no deductions for state taxes, and the lone holdout in the Senate was Senator Collins, who basically said, look, I'm not signing on to this tax bill unless you grant some of these state deductions back. And so as a part of the compromise, I maxed out at 10 grand. One of the big things that we didn't really talk about in class, that I'm actually shocked that it's lasted this long, is that the married filing joint number is $10,000. The single number is $10,000. The only way it goes to $5,000 is if you're doing married filing separate. I'm shocked that Congress hasn't decided, hey, wait a minute, this may not be what we intended to do. Again, the Republicans had no intention of raising it back up because, again, they wanted to eliminate it. The Democrats, I guess, they just haven't made a big fight of it. And so I don't know if that's something that, ends up becoming a big, huge fight in 2020 when we start having that stuff. And some of you might say, why does Kevin keep bringing up all this policy stuff? Well, here's the thing, folks. You work in an industry where federal policy really dictates a lot of what you're going to be able to do and how things work. And even though my advocacy has really been focused towards doing what's in the best interest of clients, as I see things, at some point this starts becoming personal to people, and so policy is going to make a factor. My hope is that they spend a little bit more time kind of thinking about this and realizing that. And anyways, I'm done with my soapbox. We talked about state tax deduction in class, so I'm going to pass on it. Interest. We talked about the interest. I'm going to go ahead and most likely ignore this, except for I want to talk a little bit about the $750,000 maximum. I only gave you the $750,000 maximum that we talked about in the House, but there is grandfather debt that if it's incurred before December 16th, 2017. Now, some of you might say, why December 16th, 2017? Reason was that, but the bill was pretty much finalized around that date, and that's the date that Congress chose, because what they didn't want to have happen is Congress chooses a date that says, okay, as of the date of this bill, it's going to drop from $1 million to $750,000. Next thing you know, you got this huge slew of loans. Now, I think that was a very unrealistic expectation, because home loans usually take about a month to close. Even the fastest loans, I think the fastest loan closing I've ever seen in my life was 3 weeks. I can't imagine that people are going to be, redoing certain things in order to, there just wasn't enough time to do a lot of that. And furthermore, this is around the Christmas holiday season. Most people were already planning their vacations and all that other stuff. I just don't see how that could have worked out. But anyways, they chose December 16th, so I chose December 16th. That's fine. Everything, before December 16th, you can take up to $1 million of the loan. Everything after that, $750,000. Charitable contributions, really one of the few areas of the law that did not change under the tax law. Again, money is king, cash is king. If you donate cash, so long as you hit the requirements, we talked a little bit about the $250 requirement, the $500 requirement, and then above and beyond. But for the most part, special rules apply to contributing other types of property, capital gain property, ordinary income property. We didn't really talk too much about it. It's not necessary for the test. I'm not going to hit into it too much, because donation of capital gain property, oftentimes when that happens, you're talking like something that's going to be involved with the manager. I don't see it as a big thing for staff, so I'm not, it'll probably be on the CPA exam. You can look at it for the CPA exam, but I think to get you ready to be a staff, a master staff, I don't think it's going to be that big of a deal, other than knowing that it could happen. There's limitations. The limitation is going to be your 60%, and we kind of talked a little bit about this in class anyways, but actually let me back up a bit. So in the old day rules, this used to be limited to 50% of your AGI, and then I increased it from 50 to 60%. Now, some of you might say, who in the world would give half of their income away to charity? What's the point of that? And there's different groups that are going to do this. Probably the one group that I tend to see the most are those who give half their income to religious organizations. I have one client who, his wife is a pastor. He very religious individual. He's done very well. He's got, grown kids are out of the house, and all that sort of stuff. And so he doesn't really have to focus too much on, his abilities to, he's got more than enough money coming in. Again, retired military, works for a really good company, gets a lot of, bonus money that he was paid to him while he was working. They did a severance package, which compensates him for many years. He and his wife basically just said, look, we're going to give half our money to the church. And so, I'm sorry, not half. They actually do probably around 30%. But generally where you're going to see this a lot is people who make an obscene amount of money, but because they don't need it, they're going to, they have a special cause that they're very passionate about, they're going to give to that charity. It doesn't happen very often, folks. Probably the only other time that I've seen where it comes close are senior citizens, where there's a significant amount of their income that's tax-free. And so, for example, like I said, I'm a disabled veteran, so I'll probably earn my pension tax-free for the rest of my life. My wife will then have a retirement that she gets. If it's in the Roth style, it's going to be tax-free. Maybe our rental properties are still going to be making money. I have a feeling we're going to probably have sold those by then, and then maybe we can contribute all of our money. We make we do a mixture of diversified assets, but a good portion of it's tax-free income. It doesn't take much for us to hit that 50% threshold if we're giving away 1/3 of our money. So and I'm talking 1/3 of our cash that we're bringing in may not necessarily be taxable income. So you're going to see it where a lot of retired individuals are probably going to hit this more than anything else, and they decided to increase it from 50 to 60%. I think it's a great deal because but again, if you hit a lot of that stuff, you're going to hit standard deduction anyways. I don't know. Like I said, I've only had 1 or 2 clients that this actually makes a big difference with. And like I said, one of them is one of my clients now, and I'm bless him for what he does. I mean, he's definitely given to good causes, but at the same time, and we work with him in order to be able to get this thing taken care of and get it done right. Miscellaneous item deductions and expenses not deductible, we really already talked about. One of the jokes that I saw, we were given the presentation of what's deductible and what's not deductible and the miscellaneous itemized deductions. Of course, the slide deck was prepared by a CPA firm. They said tax preparation fees no longer deductible, and they said sin. It was just one of those things. This is an area, though, that you have as an opportunity to do some examination that says, look, these items are no longer deductible, but maybe you have certain things that are taking place that are businesses that you want to be able to deduct them on, and so let's move them over from Schedule A to Schedule C. Tax preparation fees is a very common example. One of the positions I take in is, I'll admit it's an aggressive position. If you're hiring me, chances are you're hiring, say if you have a business and you hire me, chances are you're hiring me because you have the business. If you didn't have the business, you probably go back to TurboTax and do all your tax on TurboTax. Why would then the logical conclusion not be that this is a Schedule C business expense, because the only reason why you're hiring me is because of the business. Now they say, well, you're also getting a personal benefit out of it too. Understood, agreed. However, my question is, and there's definitely some case law that backs this up, and I would be very happy to show it to anybody who asks about it. But there's definitely some areas where we can kind of go, yeah, you may get some secondary benefits off of it, but the primary reason why you're doing something is for a business reason, is a business expense. Very good example. I'm going to take a friend of mine out. Well, actually, taking him out to eat is probably not a good example because it's already half off. Say for example, okay, so good example. I'm going to go to Las Vegas to participate. Oh, actually, no. Let me give you a better example. Best example I have. It's actually one that actually happened. I went to Denver to participate in a CPA Connect conference. Okay, so I flew to Denver. This was in 2017, I believe it was. We flew to CPA Connect, went to Colorado, and I was there for about a week and a half. And halfway through that week, I drove up to go visit my sister that I had never met before. It turned out I had a half-sister that I never knew about. So I went and I drove up there. Okay, I obviously got a personal benefit out of it. I got a personal benefit from it. Does that mean that the IRS can come back and say, nope, the whole deduction's denied because you got personal benefit from it? No, they're not going to do that. Now, should I bifurcate certain portions of it? I mean, I guess that there is, but then there's sort of a de minimis effect on it. And there's courts that have actually stood up and said, yeah, you get a minor benefit off of this. That's just because you went on this business trip. They're not going to come after you for it. And so, again, it is an aggressive position. And again, when I talk to my clients about it, I say, look, this is an aggressive position. This is why I feel this way. And I've got case law that backs it up. And so that's something that we end up doing. You'll see that the standard deduction amounts for 2019. It goes up. Every year it's going to go up. This is one reason why I'll never ask you to memorize what standard deduction rates are for, if it's on a test, I'm probably going to give you the standard deduction rate because I never will memorize a lot of these numbers, and you've seen it. And it's not just because I have a crappy memory, it's because there's certain things that are going to just change every year that you're just going to be like, okay, yeah, whatever, I don't need to memorize it, I'll go look it up if I need it. Now, do you need to know where to go find it if you need it? And I think the answer to that is yes. You may not need it for a test because I have to provide it to you unless I give you the research materials. But where would you go find it? And you could Google, but Google is not an answer. If you tell a partner you Googled an answer for something, I would be very hesitant to walk into that meeting and tell the partner that you Googled it. And I would never tell a client that, oh, well, I just looked on Google, this is the answer. No, that's not the answer. Now, you may use Google to find clues that can then lead you to the research material, and that's actually a technique that I use when I do my tax research. Sometimes I will start with Google, and I'll come up with, okay, this is what the answer some people are saying. Let me read why they're saying that. Okay, now let me go look up and see if what they're saying is true. And I've actually had a couple times where I found out that what they were saying on the internet wasn't true, and so obviously I was able to tell the client, look, I've seen websites that say this, but this is what the IRS really thinks about that. That's not going to work. So there's ways to use it, but you have to be responsible with it. And so that's why, and you guys have probably seen where I brought it into class where I've had the, where I have the research guide that I have, that quick find. We buy those every year. We have several copies of those that sit on the desk so that tax preparers can use those, and then life goes on with all that. So that's actually a better benefit for that. Use those quick finders because they're professionally prepared, and you know the information is going to be correct. Now, there are a couple times where I've seen where the quick finders will give you a quick and dirty answer that if you went back and looked at it specific to the circumstance, you might get something different, but that's why you have to be knowledgeable in that area. So anyway, so I've said my piece on that. Talk about bunching deductions. Something that I've done with a client once. I had a client who was going to deploy in the military. Had received a significant amount of money as an inheritance, and was trying to make up his mind whether he wanted to donate. He wanted to give it all to church. He didn't need it, and he says, "I don't need it. I'm not greedy. I want to help others." And this guy was the epitome of service. I mean, number one, he was a military officer. Had given up 25 years of his service. His wife, didn't work. Gave up her entire career to support him and the family while they did this. And then, in addition to her taking care of the kids, she also spent an exorbitant amount of time with service organizations, volunteering her time, making sure that everything went well for. I think she did a lot of volunteer work with service-related organizations, military service organizations, USO, various organizations like that. But then also did a lot of organizational work with her church. This is just the epitome of service to these people. And all of a sudden, they come into like $100,000, and they're just like, we don't need this money. And I'm sitting there going, wow. I wish I was in that circumstance. But that's just the kind of people they were. And so they said to me, Kevin, if we're going to give this money, what do you recommend? And we did an analysis, and we said it's better to give now rather than do over time. Because originally what he wanted to do was spread it out over 2 or 3 years so that he could, he thought he would maximize tax deductions off that. And I said, actually, no, you're not. Because what's going to happen is, and we were talking about this in 2017 when we knew that the tax law was going to change. And I knew the exemptions are going away in standard deduction. We hadn't seen the final version of the bill, but we knew that. And so I said, hey, look, maybe what you want to do is do the huge deduction now, and then go forward, take standard deduction. That ended up working out better for him, and we did sort of a plausible. We did a scenario analysis with that, and we actually showed him the benefits of it, and it actually worked out. Which he paid for, so I was very happy to do that for him. But at the same time, we ended up saving him $1,000 in order for him to do that. Deduction for qualified business income. This is something that this is a real new portion of the law, and some people might say, what is this? And so we're really going to talk a lot more about it in not chapter 3, but in the third section of the class when we get to business deductions. But here's what it is. So if you're a self-employed individual and you are or if you have a pass-through, and pass-through in definition, in the tax industry, pass-through is a very easy definition. It's basically any partnership or any S corporation was definitely a pass-through. We never really looked at sole proprietorships as pass-throughs, but in effect they are, because what happens is the business doesn't pay any tax. All of your business, your tax elements go onto your personal tax return, and then you pay the tax. So it's technically a pass-through, and luckily in the statute they actually defined this as a pass-through, so end up working out. So a very common group of people that I see that get this deduction are real estate agents. Because they own their own business, they're contractors, and so what they do is they go out and they make all this money, and then they have self-employment tax, they have regular tax they have to pay. It's a lot for an individual to have to go through, and so what ends up happening is, what we do is we say, okay, fine, we prepare your tax returns, blah, 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 but the Congress basically said that we're going to give you a 20% of your business income as a deduction on your tax returns. Now, some might say, well, wait a minute, why are these guys getting a 20% deduction and everyone else isn't? The reason why they did this deduction is because when they dropped corporate tax rates from an average of 35% to 21%, there was a huge debate, and I actually still remember this. I was watching this. I actually saw this on Facebook a lot. This was being passed around on Facebook. The congressman who was asking then, I think it was Secretary Mnuchin, might have been asked this, or it was the IRS commissioner. I can't remember who it was, but he was being asked. He said, "Wait a minute. So if why is it we're dropping tax rates from 35 to 21 for big corporations, but the little guy where it's a pass-through event, and they put it on their tax returns, what's their max tax rate?" And they said, well, it's up to 37%. So if you're a small business and you put it on there, you're going to pay 37%, whereas the corporation is going to get 21%. What are you going to do? Oh, everyone's going to be, there's going to be this huge sucking sound where everybody takes their business and incorporates. Okay, that's and that wouldn't be a bad thing necessarily. It might be a good thing, but they said, look, we're going to give a deduction, this qualified business income deduction. We're going to take 20% off, and then that way it sort of migrates closer to that 21%. Now, I will tell you, after having done taxes for this for a while now, and after having done a lot of analysis on this rule, I'm not sure this is as juicy as doing the corporation rule, but with the double taxation effects of C corporations, and then some of the other tax effects that corporations have that pass-throughs don't, there's some people I've just said, it's not worth it. Don't even bother with it. And so we've kind of stuck with that. Now, the big thing that you're going to be talking about with clients on this is this thing called a specified service trade or business. And what is a specified service trade? And there's actually a definition in the code where they actually list certain industries. Very good example is engineering firms, consulting firms, lawyers, doctors, accountants. So we are what we call, and they call them SSTs for short, or SSTBs depending on who you're talking to. But the SST limitation basically says, look, if your taxable income is below, is above 160,700 or 321,400, what ends up happening is that, if you're married filing joint, what ends up happening is your 20% deduction starts going away. And so, there's some people that we've kind of come to them and said, look, I've done the analysis on this. It doesn't make sense for you to pay tax on this anymore. My recommendation would be go ahead and do this as a move from an S corporation to a C corporation or whatever, or as an LLC, you just elect C status. and this is an analysis that we've done with a lot of our clients to figure that out. You may end up having to be part of a team that's going to do that analysis, and I just want you to kind of understand that some of the times these SSTs will have that. Now, a very good example of what's not an SST, a very good example is landscaping. Landscaping is not an SST. So you go out there and your company makes $500,000, you're still going to get that 20% deduction. Now, there are certain wage limitations and taxable income limitations. The wage limitation is that the 20% deduction cannot be greater than 50% of the wages that you're paying out. So the thought process about this is that if you're a small business, you're going out and employing people. They want to encourage you to employ more people, and so that's usually what limits that if you have it. So the SSTs don't have that limitation, the businesses that are making under $160,000 and don't have that limitation. But the SSTs, but the wage limitation really kicks in once you get over that, and so. Very good example. I do have a client who's a landscaping business. They're an S corporation return. He hires an exorbitant amount of people though to do his job. He doesn't like, he loves getting out there and designing stuff. He's really good at the designing stuff. But he's got a really horrible back, so he doesn't like to go out there and do a lot of the lifting. So he hires other people to do the lifting. Pays him really well. So his deduction's really good. So that's the way it is. Okay, so we're going to talk a little bit about Chapter 7, and I've already done this in the morning class. I just want to kind of catch the later class up to date on this, and also the morning class. Hey, if you kind of went through the class, and I know there are a lot of sleepy heads, shall we say, and so if you were kind of like, I'm not really following this, this will be kind of a good refresher for you. Okay, so the first thing that we talk about, investments overview, before rate of return on tax, before tax rate of return on investments and after tax. Of course, we do this sort of analysis. It doesn't really affect, in tax we sometimes do a little bit of this. Finance does tons of this. Okay, so if you're ever working for a corporation, or if you're working there, you have a corporation that you're doing as a client, and sometimes they come to you and say, look, we need our blended tax rate in order to figure out our tax rate for the investments and stuff. That may be something that you have to provide to them, and so you're going to ask for various tax rates. They're going to say, what's my marginal tax rate? What's my ordinary tax rate? What's my capital gains tax rate? What's my blended rate? Things of that nature. So there's going to be certain aspects where they're going to ask you what the tax rate is in order to be able to do that, and so you need to kind of know how that kind of works out. And I know you're going to talk a little bit more of that in your finance class, so I'm probably not as serious in talking about it here. Obviously, would there be some benefits to it? Yeah, but at the same time, I think we should just focus on just what we would do as tax preparers. So portfolio income, we talked about the 3 buckets. Okay, so the 3 buckets are active, passive, and portfolio. Okay, so the active bucket, a very good example of your active bucket is when you go out and you earn wages. Okay, so with the active bucket, you are, you say, for example, I remember when I was a kid, I used to work at McDonald's. I was a burger flipper. I go and I actually flip burgers. I make wages. That's active to me. Okay, then you have passive income. We'll talk a little bit about passive income here in a minute. But portfolio income is what we're going to talk a lot about here in Chapter 7. That's going to be your interest, your dividends, and your trading that you're going to be doing. Stocks is a very good example of portfolio income. Passive income, and we kind of talked a little bit about this. That's where you have sort of the maybe you work hard and you're the rich uncle in the family, and you got a nephew that you love a lot that wants to come and says, let's go form a McDonald's, and so we'll do a partnership. You give me the money, I'll do all the work. Sounds like a good deal to you, right? So what ends up happening is you form the partnership, and partnerships, when we do this, we actually form we actually do what we call, the symbol for partnerships is triangles. And so then the individual owners will be the circles. So each one's going to have their own ownership in this aspect. And so what ends up happening is, I'm an owner. My nephew's an owner, and you know what? We've always picked on nephews. Let's pick on nieces a little bit. So maybe my niece is the one that I want. My nephew, he's doing good, but he's going to be an engineer person. My niece is the one who really cares about people, and I know she's going to do really well with customer service. And so I say, look, we're gonna have you come with us. So she's going to be the one I work with. So she's an owner, I'm an owner. Now with her, I basically say, look, I'll pay you $40,000 a year to manage the business. Everything else is 50-50 between the two of us. And you're going to go to work every day and do all the stuff. I'm going to go to my office every day and do what I normally do, and then I'll check up on the business every now and then. To my niece, this is an active business. Okay, so I've got one partnership, but it's going to be active to her. Because she goes in there, she flips burgers, she manages people, she deals with the issues, she counts cash, she does everything that she needs to do in order to run the business. So any money and income that she gets that's going to be attributed to her is going to be active income. For me, this is passive. And the reason why it's passive is I'm not going in and doing anything with this. I've given her money. This is an investment. Okay, so some people might come to me and the reason why I kind of call it that investment, we call it a passive investment activity. The thing is that it's an investment activity for me. It's not something that I'm going in and I'm saying, gosh, I want to work hard and make tons of money. This is where my money starts working for me, or my niece with all my money is starting to work hard for me, and I'm getting half. Okay, so I can't complain about that. But to me, it's passive, and so when I fill out my tax returns, there's going to be a passive aspect to it. But going back again, this chapter we're going to talk about portfolio. And so portfolio income, the way it gets taxed, and look, you could have active income that is taxed at I would say 99% of active income is going to be taxed at ordinary income rates. I don't think there's any capital gain active income that I can think of off the top of my head. You then have passive income, which could be taxed at ordinary rates or capital gains rates, depending on the type of income it is. You can definitely have passive dividend income, and we could talk a little bit about that more as we go. You then can also have, now with portfolio income, it's more likely than not going to be taxed at capital gains rates, but there's some portfolio income is going to be taxed at ordinary rates. Very good example, interest. Interest is always going to be taxed at ordinary rates, unless it's tax exempt. I've not seen any vehicle that would ever give me dividends rates on interest. Okay, and so you have interest. It's taxable when it's received. Interest from bonds, CDs, savings accounts, ordinary income taxed at ordinary rates unless municipal bond interest. Interest from U.S. Treasuries are not taxable by the states. And we've talked a little bit about this with municipal bonds. If I buy a municipal bond and I'm a Virginia resident, I buy Virginia bonds. I don't have to pay taxes on it at the federal level or at the state level. Federal is going to make it tax exempt. State's going to make it tax exempt because it's a Virginia bond. If I buy a Kentucky bond while I'm a Virginia resident, Virginia wants to tax it. The IRS isn't going to tax it though because it's still not taxable. Interest from Treasury bonds. So if I decide that that we got $4 trillion, well actually more than $4 trillion, it's probably more like 19 by now, $19 trillion in debt. The government says we need to raise money in order to keep this debt going, and I say, gosh, this looks like a safe investment. I'm going to go ahead and I'm going to buy some Treasury bonds. Say I buy, I put $15,000, $20,000 in the Treasury bonds, and this is a part of an investment portfolio that I have and all that. The U.S. Treasury bonds are going to be 100% taxable at the federal level, but at the state level they cannot be taxed, and that is actually that's due to case law that took place that prevents that from happening. Okay. When we get to the dividends are typically taxed at preferential capital gains rates. And when we look at preferential capital gains rates, what does that mean? So C corporations have this nasty aspect called of double taxation. So in other words, if my C corporation makes money, say it makes $100,000, it's going to get taxed 21% of that. And then when it takes that money and then dividends it back to me as the owner, I then have to go ahead and I have to pay a tax on that money too. So it's basically money that gets taxed twice. So we call that double taxation in the industry, and it's a very unpopular portion of why of C corporations and all that. And so why sometimes when we talk about the popularity of C corporations versus not so, that's one aspect that gets brought up. Congress back in the early 2000s came up with it. There was a lot of fight for this, and in fact, I told you about a presidential candidate who ran for this named Steve Forbes. You might know his name. His family was part of the empire that built the Forbes magazine. One of the things about him is that when he ran for president, he had this phrase, "Tax once, tax at the source," and what it meant was, corporations pay the tax, and when they dividend that out to their investors shouldn't be paying a tax on that. And it was, I remember this was a very controversial statement for a couple reasons. Number one, typically people who are going to own stocks and receive dividends from them are typically not, let's just say they're not the poorer half of the country. So, the majority of people who would have received the benefit from this benefit would have been, sort of the more wealthy individuals. Something I think that failed, though, is that, and this is something that I didn't actually realize until I started doing tax professionally, a lot of people who also receive dividends on a regular basis are also retired individuals. So what will happen is retired individuals have their 401k account. Maybe they have to take some of it out as a result of the RMD requirements. They don't necessarily need that money to survive off of, so they take in the investment. They then get dividends off of that. And so it actually ends up being a benefit to them if they had this provision. Sort of the compromise that they came with it was that, hey, look, instead of taxing this at ordinary rates, because it is double tax money, it does violate that tax principle that we kind of have. But what we're going to go ahead and do is we're going to drop that rate from the ordinary rates to the capital gains rates. But it's only on companies that would typically have that double taxation. Now, over time, another provision that kind of got added into this qualified dividends, and I don't know if it was added in immediately or if it was later on, the provision that got added into this whole thing was the provision of the foreign companies that were under our tax treaties. And typically what happens in a lot of the tax treaties anyways is that we say, look, interest and dividends are going to receive a special tax rate anyhow. So if you're being taxed in the United States on U.S. sourced income, but I'm technically a resident of, say, England, maybe the English citizen, maybe the tax treaty for the English tax rate would be less than that. I don't think it's actually that way for England. I know there's a few tax treaties that have that. I think the French has one, but don't quote me on that. It's been a while since I've had to deal with dividends rates for residents of other countries, because usually when I'm dealing with their tax returns, they're residents here. The big question is how do we treat dividends received from the other country, and oftentimes when they move here, they'll also move their investments over here. Portfolioing interest, the second two, why invest assets yielding interest or dividends? Why do interest versus dividends? It's actually, this is actually, in my personal opinion, it's outside our swim lane. We shouldn't be telling clients where to put their money. That's just not our job. Now, if you happen to be one of those CPAs who goes out and you have your CPA firm, and then on top of it you have your investment license, different story. You can talk to your clients about this all the time. There are several diversification reasons why you want to do this. Risk is a big one. Putting all your eggs in one basket. Something we learned about the Enron crisis. There were several employees that their only investments were in their 401ks that were solely invested in Enron stock. And what ended up happening is that they were frozen in a lot of their transactions that they could do, but the company ownership could move money around left. They could buy or sell the stock anytime they wanted to. So what ended up happening was when the management was noticing all the trouble that was coming down the pipe, they sold out and basically left the rest of the company owners to hold the bag afterwards. This resulted in a lot of changes in a lot of areas of investments, and also in management ownership of stocks over a particular set of time. So and all that. So we have, like we said, we do the qualified dividends. They're domestic and certain foreign, and actually the IRS puts out a RevProc. I believe it's every year on this. Don't quote me on that, but I know it's a RevProc, and I always every time I see that a new one's come out, I always print it off and put it on my desk, so that if I see that a dividend comes from a certain country, I know that it's a qualified rate versus a non-qualified rate. Subject to preferential rate. What does this mean? And this is something we kind of talked a little bit about, but we didn't really, and we kind of harped on in the first class, but in the second class we haven't yet. Basically what happens is your capital gains preferential rate is going to be determined on what your marginal rate is. So if your marginal rate, and I'll go ahead and I'll put a copy of this on the screen here. If your marginal rate is one of the first two tax rates, with 0 and 12%, your capital gains rate is going to be 0. Okay. Now, if you are, one of those who makes a lot of money, and your capital gain and and your marginal rate happens to be at 37%, your capital gains rate will be at 20%.
Everybody else is going to be at 15%. Okay, so what ends up happening is you will have to, this is a rate that your clients are going to ask you for, because when they go to their financial advisor, the financial advisor will ask, hey, what's your tax rates? Now, 9 times out of 10, they'll ask for a copy of their tax return anyways. I always make sure that they have a copy of what's called the return summary, which is a product that my tax project, that my tax software produces, that basically says, hey, we prepared your taxes, this is what your tax summary looks like, and then it also has your effective rates, your marginal rates, and then your capital gains rates. And that's actually very helpful with financial advisors. Non-qualified dividends are taxed at ordinary income. So what is a non-qualified dividend? Basically anything that isn't a U.S. corporation, also isn't a foreign corporation that qualifies for the lower rates. Common one that I have a client who is invested in investments in Peru. So his Peruvian investments are not qualified. I don't think there's a tax treaty, at least we haven't seen one, that he has to take his rates at. So capital gains, you're going to have investment held for appreciation potential. Very good example, growth stocks, land, mutual funds. What is a mutual fund? We kind of talked a little bit about the first class, again, not the second class. Mutual fund is, if you think about it, if I want to go out and buy some Apple stock. Now, Apple stock is a very expensive stock. I want to say it was either $600 or $900. It's one of those two. I don't really follow the stocks that much anymore. But say, for example, I want to run out and go buy a stock, and it's a $750 stock. We'll just kind of split the difference on that. And so I say, okay, here's $750, I go buy my one share. Okay, now you're not really going to have a whole lot of diversification with that. So if Apple goes up, it's a great day. If Apple goes down, it's a bad day. And this is something that investment advisors don't recommend. They want you to be diversified. They want you to have a wide range of stocks that you're going to have available to you, so that if certain stocks are doing really well and other stocks are doing horrible, it kind of balances out, but allows you to gain sort of that appreciation over the long term. And so in order for me to achieve that diversification, instead of me putting $750, what if I could buy a controlling interest in not a controlling, but say I could buy an interest in Apple using only $50. Well, I could accomplish that because I could have me put in $50, and then on top of that, get 14 other of my friends to buy into a company that puts in $50, and then we could own one share of stock together. Okay, that's sort of the theory that happens with mutual funds, but take that and multiply it on steroids. Some capitalization rates for them are into the billions. Okay, so millions, definitely. I think 1.5 billion. I think is the highest I've seen for a mutual fund that I've invested in the past. I'll be honest, it's not my area. I did not stay at a Holiday Inn Express, and I'm not even willing to take that option. But the mutual funds, what ends up happening is there's an aspect to this that we need to be very, very careful that that clients get into these. Now, when I say very careful, U.S. mutual funds, no issues. But if you get clients who get involved in the foreign mutual funds, very huge issue. There's a very huge tax implication as a result of that. And if that happens, they need to see an international tax advisor as soon as possible. Other assets, precious metals, and collectibles. We talked about this. Collectible tax rates, tax rates on collectibles is 28%, not the standard 0, 15, 20. Very good example of collectibles, coins, not precious metals, but it could be gold statues, silver statues, platinum statues, could be statues that are marble. That's considered a collectible. One of the things that I do sometimes use as an example are Disney palaces. They used to have these little Disney crystal palaces that you can buy that could be valuable. So there's things of that nature that you could have that you're buying and selling, and as a result of which you're making money off. Another, art. If you own a Picasso, and you want to sell it, then that gains tax 28%. Nothing you can do. Investments held for appreciation potential, gains deferred for tax purposes, and then there's tax that can be taxed at preferential rates, and the special loss rules applies. Okay, so the gains deferred for tax purposes. Here's what happens. I buy a share of Apple, and between now and the end of the year, it goes up 5%.
Do I pay tax on that 5%? The answer is no. It's deferred until I sell it. Okay, so if I go out and I actually own this share for 5 or 6 years, I will defer that tax until I sell it, and then pay the tax on whatever the gain is between buy and sell. And so that's a very big tax advantage, because I control when that tax event's going to happen. I don't get taxed until I have the actual money. General tax preferential rates, we already talked about that. If it's capital gains rates and you've held it for more than a year, long-term capital gains rates, it will be taxed at that. Now, again, if it's short-term, which is a year or less, you'll be taxed at ordinary income rates. So, you want to make sure that your clients are well aware of that when they're making their investment decisions. Special loss rules apply. That's where we have sort of the $3,000 limitations that you can take against stuff. There's also wash sale loss, which we'll talk about here in a little bit. These types of investments are called capital assets. That's from an investment standpoint. Capital assets has a different definition when we talk about business assets, because that means anything that would have, potential capitalization potential. Capital asset is any asset other than using an asset or trade or business. That seems to go against what I just said like 2 seconds ago. That doesn't mean that assets in businesses can't be capitalized, but it's not by definition a capital asset under the tax code. A capital asset is something that we use primarily for investment. We buy it, we hold it for capital appreciation, and then sell it. That is technically a capital asset under what they're talking about here. A little confusing, but I think over time you'll kind of get to that. Accounts or notes receivable acquired in business from sale of property or services. What's this? Your accounts receivable. And I think that kind of makes sense. If I'm going to go out and I'm going to sell something to you, say I sell, ice. Very good example. I'm actually, I've got a nice glass of ice water right here. It's actually very hot in this room because you can't see it here, but I've actually got a lot of lights. That happen and actually raises the temperature. In fact, I've had to shut off the camera several times because the camera's overheating. So we've had our mix ups and downs about that. But if I sell ice and I make the ice and then I sell it to you and you say, okay, Kevin, send me a bill for it, and I send you a bill and then 20 days later you pay me the bill on it, that's an accounts receivable. Obviously, that should not be a capital asset, okay? Inventory is another good example. My ice in and of itself is not an asset. It's not a capital asset. What it is, it's going to be an asset in terms of inventory asset. So when I sell it, I generate an ordinary income off of it. Therefore, it cannot be a capital asset by definition. So sale of capital assets generates capital gains and losses. And so then what will end up happening, you have specific identification versus FIFO. When you're actually determining which assets are determined to be sold. So say, for example, I buy a share of stock of Apple today, and then 3 weeks later I buy another share of stock of Apple, and then 3 weeks after that I buy another share of Apple, and then I sell a share of Apple. Which share have I sold? Well, the IRS, shares of Apple are not serialized in that way from a tax perspective. The reporting of it's not like you sold share number 14755673321. That's not the way they do it in tax. What they do in tax is they say, you bought these shares, you sold these shares, and it's just an amount sort of thing. That gives us some potential opportunities in tax to do some tax maximization, benefit maximization for our clients. So, for example, and I told you about in class I had a client. She's not a client anymore, unfortunately. Her stuff got real simple. It just wasn't beneficial for us to continue on anymore. She used to own some Bitcoin. And so she bought some Bitcoin and then she sold it, and she didn't, she was looking at it, she saw the gain, she's like, holy smokes, I'm going to get hit really hard with taxes on this. What had happened is that she had bought Bitcoin during times when it was up and down and up and down and up and down. And what we did is I said, look, I can save you from this hit this time, but it's not necessarily going to help you later. And she said, okay, fine. So what we did is we specifically identified shares of the Bitcoin that she had that were higher basis, which basically lowered her tax. Now you might come back to me and say, well, how did that help the client? Later on when they sell the coin, they're going to just pay the higher tax later on. So it's really a tax deferment strategy. Here's what happened. Bitcoin took a dive right after that, and then she ended up selling it. Well, she still had a gain because a lot of the coin that we didn't use when we calculated her gain the first time was very low basis. So she had a gain, but it just sort of reduced that gain. So from the IRS perspective, did they really lose anything? And the answer is, over a period of time, no. It's just that instead of having these huge gains and then later on these huge losses, now the bad news for the IRS is that because we were allowed to use specific identification, she didn't generate any losses on the ones when she sold it in the following year, and therefore those losses would have been pushed to the forward year. Although the IRS, I think, in my personal opinion, benefited from that because the loss mitigation allowed it to take capital against capital as opposed to her taking $3,000 of ordinary losses going forward. I think that would have worked out worse for the IRS. So actually, in the grand scheme of things, it all worked out. She was happy because she got to mitigate some of her losses, and then other people were happy. The IRS, it worked out for them too. Long term, like we said, if it's more than a year, short term if it's held less than a year. This is an important point. You might want to remember this. You do need to know this for the test. I'm just going to say that, and that's it. Capital gains, net short-term capital gains are taxed at ordinary rates. Generally, net capital gains that are long-term in excess of short-term capital losses are taxed at a maximum preferential rate of 0, 15, 20, depending on the taxpayer's filing status. Certain gains from sale of depreciable real estate held long-term are taxed at a rate of 25%. We'll talk a lot more about this when we do the property section of this class, which is the second section. We're still in section 1. But essentially, you're going to have there's 3 code sections you have to memorize. And it's one of the few that we do in this class. Code section 1231, code section 1245, and then 1250. And we'll talk about how a lot of that is. These are code sections that confuse the heck out of people who don't understand tax. But if you understand it, you've got a very valuable understanding of this. And actually, property tax transactions were a favorite thing of mine because they, once you understood the process, it was Mickey Mouse, and it made me look like I was a lot smarter than I really was. Long-term capital gains from collectibles, we talked about 28%. Capital losses, individuals, including married filing joint, are allowed to deduct up to $3,000. So, if you're married filing joint, single, head of household, $3,000. If you're married filing separate, $1,500. Okay, so we want to make sure that we're keeping that aware when we're doing a lot of that stuff. Okay. Capital gain loss netting. Now, and I've said this in the first class, and I'm going to say it to the second class, and I want to get this on the record. Don't worry about this. I'm not going to sit down and have you go through step 1, do this, step 2, do this, step 3, do this. Because here's the problem, folks. After you leave this class, 99%, you're not going to ever do this. Okay? You're not going to ever do this. You're going to put all your stuff in your software, and your software is going to figure the stuff out for you. I've told you 100 times, and I'm going to say it 100 more times probably before I say it another 100 times. I don't think the benefit in tax nowadays is calculations. If you're getting into tax accounting because you like math, you're in the wrong time period. You should go back to the 40s or 50s. That's when math was more valuable for that. Nowadays, computers take care of all the math. Okay, now we have to understand the numbers. We have to understand what makes sense. Because, in a very good example, I had a tax return I was doing very recently that I pulled it up, and I'm like, this doesn't make any sense. Why would the numbers equal that? Okay. And when we took a look at it again, we were kind of like, oh, now I understand why. Because we understood the number relations. I think number relations is a very important skill to have. I think, understanding that 1 + 1 = 2, again, I think computers are handling a lot of that. And so I'm not worried about you figuring out this process. This process is handled by those computers. Now, obviously, you want to understand it. But it's not something that I'm going to ask you to pull out and whip out here's your capital gains, here's your capital losses, here's your capital gains, here's your capital losses, and figure out step 1, step 2, step 3, step 4. there's an overall process that we're going to do, and we'll do that when we do the exam review, where I'm going to show you what you need to do in order to get past the test and understand what you need to do going forward. There's some limitation of the deductible losses. Gains are taxable as capital gains. Losses are non-deductible if they're personal use assets. So what that means is, I have a car, I buy it for $10,000, I sell it for $20,000. Technically that is a capital gain asset. It's something you're very rarely going to run into in the real world though. Very rarely. First of all, most clients don't know it, so they don't actually report it to you. But that's why we have an organizer where we say, hey, did you have any disposal of any significant assets? Second of all, the majority of assets that people own, the majority of capital assets that are personal use assets that people own, cars, boats, and boats are very rare and few between too. More often than not though, those assets are not going to appreciate in value, they're going to depreciate in value. Very good example, I bought my Toyota Camry for 2014, probably paid around $21 for it. I'll be lucky if after 10 years I get to sell it for 10. This is going to be a capital loss. Does that mean I get to take a deduction on it? No. Now, if I took that and it was a business asset and I sold it as a business asset, different story. And there are some things where we do that with people who own their own companies, and we say, look, you've got an old car that you want to use, you like using it in the business, why don't we go ahead and turn that over to a business asset, and then you can go ahead and buy your own personal asset. There's various reasons why we would do that, and it's a good deal to do that. So but that gets back into tax planning. It's something you should be doing as a manager, not as a staff. Okay, so now it might be something you could suggest to a manager, but and I've told you this before, your job when you first get into the accounting firm and you're a tax staff, your primary job is to learn the software. Hands down. You want to go from some staff to senior, software management is going to be the most important thing that you got to learn. As you're doing that software management, you're going to pick up a lot more of these rules, and you're going to pick up the rules that are very important for you. As you do more and more of that, and then later on get to the senior world, then you're going to start to really be getting to the, okay, now I need you to actually understand some certain rules about tax. And then as a manager, you need to be able to sit in front of clients and basically explain to them their tax return and also talk to them about tax mitigation strategies. That's what you really need to understand. So I'm not really too concerned about asset benefit maximization at this point in your stage. Okay, it's not critical for you to be successful at this point in your game. Capital losses from related parties are not deductible currently. So this is important. If I take a piece of property, say I have my house, and the value of it is low, and if I sell my house, there's going to be no benefit to me. Or even more so, there is a major gain on that house. Okay, so I bought this house. Say I paid for this house, $400,000, and then I'm going to go ahead and I'm going to sell the house, and the house is valued at $500,000. But I don't want to sell that and maybe take a potential tax hit. Maybe I don't qualify for the gain exclusion that we talk about. Either I think it might be actually later on, or later, or in another chapter. Maybe I don't qualify for it. Maybe I don't have the 2 years in the last 5 years of ownership and use test. And the reason why I'm leaving is for another reason. I could take this house and I could sell it to my cousin or to my brother or sister and say, hey, I'm going to transfer this house to you. Say I bought it for $400,000. I'll transfer it to you for $350,000. I would have a $50,000 loss. Now the IRS is going to come back and say, hey, this is not an at-large transaction, and you're selling it to a related party. And the IRS, generally speaking, there's not an at-arm's transaction exception that happens a lot of times with sale of real property to relatives, because the IRS, there's just too much room for potential problems. Now there are some areas where there is an at-arm's transaction to related parties. For example, if I have a rental real estate, if I have a rental property, and I rent it to a family member, losses are disallowed unless I can prove that I'm renting it to that family member for fair market value. And there's ways to do that. You go to a real estate agent and you say, I need a market analysis on what my house would rent for. And you just make sure that you keep it at or above that number. And if you do, and you pay that real estate agent for that amount, the IRS probably is going to leave you alone on it. Okay, but there are some exceptions to that. Selling property is not that way. If you sell a property at a loss, it doesn't matter if it's an arm's length transaction, or if you can prove that, hey, if I sold this to anybody else, I still would have gotten a loss. You're not going to have that. What's going to happen is that you're going to get the loss disallowed. Now, what will happen what that means is the person who buys your property, the basis in that cost is going to be whatever they paid you plus the loss that was disallowed. So you're basically going to transfer that loss to them. But we're not going to get into that. That's way beyond this class. Wash sales. This happens a lot in stock sales, and we kind of talked about this in the first class. There's a 61-day period centered around the day of sale, so it's 30 days after, 30 days before. If I buy a stock that, okay, so actually let's back up. I get to the end of the year, and I notice that I've got $50,000 or $15,000 in gains, and my stockbroker says, you know what, I don't want my client to get hit with $50,000 in gains. It's going to hit him on a good tax bill. So he goes to the portfolio, and your your financial advisor says, you know what, I've got these 4 or 5 assets that put together are $15,000 in losses. So how about I go ahead and sell those, generate $15,000 in losses, I have $15,000 in gains, get 0 net for my client, so they're happy, and then I can just go repurchase these assets later on. If I'm going to do that, I have to wait till I'm outside this wash sale rule. Okay, because what the IRS is essentially saying is that you're loss harvesting, but you're only doing it simply for a tax avoidance purpose. Okay, now there's a lot of buying and selling that takes place in a lot of these portfolio accounts, and you have to understand a majority of these rules, like the wash sale rules, were developed back way before a lot of the hyper trading that takes place happens with most ordinary Americans. Most of the time, the guys who did a lot of the hyper trading were the rich people, because they're the only ones who could afford people who could go in there and do a lot of this hyper trading, because there weren't computers back then. And, remember the old ticker tape that they'd have to watch, and oh yeah, I see that Rockefeller Oil's down, whatever it is, and they'd have the ticker tape that would come out and all that sort of stuff. They don't do that anymore. So where your clients are going to get tripped up on this is that, especially if they have, I have one client who he has multiple trade accounts, and one account's what he calls his play account, and that's where the stockbroker can go in and basically make all these different trades, what he calls micro trades, and they're trades they're just buying and selling stuff left, right, up, and down. Well, if he sells something and then buys something else, there's a wash sale limitation that takes place, so they have to make sure that gets taken care of in that sense. It's in, so the intended, you can't deduct lost sales when it's essentially continuing the investment. That's kind of the point. The IRS kind of looks at it and says, look, you sold it, but you bought it again. You really there hasn't been a loss. And look, again, there's a lot of areas where I disagree with the IRS. This is one where I kind of agree with. Substantially, you haven't done anything. Nothing's taken place. And that's why I kind of think that this wash sale actually makes sense. Now, how do you avoid this? Wait 30 days. If that's your whole goal, you can definitely wait 30 days and make sure that happens that way. Okay, so talking a little bit about some tax planning strategies for capital assets. Again, like I said, I don't think that staff should really be worrying too much about this. It's probably a good idea to know a little bit about this just for your own personal edification. Not everyone's going to go into tax, and so there might be some things that you can do. That, you go become an auditor and then eventually become a CFO of a company, and you make millions of dollars, and you want to make sure that your investing is making sense, and you're a CPA, so everyone expects that you know this stuff. Anyways, you probably want to know a little bit about this. Number one, hold your capital assets for more than a year. That kind of makes sense. If I say I buy a share of Facebook right before it goes IPO, it goes way up. Now let's assume it did not go down as it did, but it goes up and it stays up. Hold it for a year. If you hold it for a year, you instead of paying gains at short-term rates, you're going to pay it at long-term rates. It's going to save tons of money in tax. Loss harvesting. $3,000 offset against ordinary income, other offset other short-term capital gains. So what they're trying to say here is they're saying, hey, look, if you go and you purchase, and say you have all these you have all these gains that you have, but you also have all these losses that you haven't realized. Going in and taking those losses at the end of the year, and this is something that a lot of investment brokers will do. They'll take a lot of losses at the end of the year, and then what they'll do is they'll report those losses, and then later on they go and they'll buy either buy the same asset, or maybe they just say, you know what, that asset stinks. I don't see any potential up to it. We'll go somewhere else, cut our losses, and move on. It's better to have it to where you can offset it against gains than it is obviously taking a $3,000 benefit, because the $3,000 benefit for a lot of the people who do a lot of this, $3,000 ain't much. I mean, the value of it is probably only 30% of that. So you're talking like $900, which in the grand scheme of things, these guys are probably dropping, $30,000-$40,000 in their taxes. $900. I mean, it's to you and me, it's a lot of money, but to some of these other people, it isn't. Must balance tax and non-tax factors. What happened in the stock market in 2008 this is a good example. Not just 2008, but I would say in 2000. We also had a minor crash after the tech bubble burst. I know this personally because I was getting an MBA focused on MIS at the time, and realized my career options were slowly disappearing. And so there's definitely you want to make sure that you're balancing your I always tell people, if you're doing things solely for tax, you're an idiot. You should be doing things for a reason, but considering tax implications, I think, is a much smarter way to go. Investment interest expense, we talked a little bit about this in previous classes on Schedule A. In order to do an investment interest expense, you have to have investment income. And then there's a form that you got to fill out in order to get this done. You fill out that form and everything works out well. You'll get the investment interest expense deduction. Investment expenses outside of interest are non-deductible. They used to be deductible under the old tax law. As of now, they're not until 2025 when they turn them back on. I don't know, between here and 2025, the world could happen. That's 6 years into the future. If you told me 6 years ago that, things would have worked out, 6 years ago was 2013. That's when the Affordable Care Act was really taking it. If you would have told me that the Affordable Care Act would have gone the way of the dodo at this point, I wouldn't have believed you. So the world has definitely changed in the past 6 years, and nobody can doubt that. And the 6 years before that, a major change. So I think that what's going to happen, I don't know. I think it's a lifetime, and I leave it to no politician. I leave it to all politicians to eventually come to the point and say, okay, we see a political game here that we could do that gives people these things back. Okay, so again, not to pontificate, but just kind of to talk about a little bit of this. I'm just kind of surprised that they haven't done this, and I would anticipate in the next few years that at some point, retired individuals will eventually, start to stand up for this. We'll see. I would have thought it would have happened already, to be honest. After that, my thought was, when we first did this last tax return for 2018, the first year all these new tax laws went into effect, I would have figured there would have been this huge, massive uproar, and there was kind of a whimper. But we'll see. Passive activity income losses. We will talk a lot more about this in section 3, where we get into business income. Typically, an investment in an S corporation or a partnership or a direct ownership in rental real estate. There are times where investments. They say ordinary incomes can come from these investments, but I've also seen where there are potential capital gain tax rates used with passive. A very good example. Typically, technically, if you sell your interest in a rental real estate, you get there's some capital gains rates that could take place. What we call 1231 property. If there's gains, that technically is passive income. Okay, your capital gains rates at passive income. So there are times where this can happen. They tend to say that it doesn't happen at all. I disagree with that, and maybe it's because they're talking about investments. Generally, that's not going to be the case. It depends on what the purpose of your corporation and your company and all that stuff. But generally, it's not going to. That's an advanced class discussion, and we'll get into that a little bit more. Ordinary loss may be deducted currently if able to overcome tax-based limitation. Yeah. So we talked about the three buckets: the active, passive, and portfolio income. There's another. What we call the three buckets, but this is where I call it the three buckets with the holes. And what it does is that they say, look, there's three levels that you kind of have to get through, and if you can get through those three levels, you can actually take the loss. And the first thing, and of course you've got tax basis limitations, at risk, and passive loss. But again, kind of just give you the, hey, stand by for more. That's kind of what this is about. Losses may not exceed a tax basis, investor's basis in the activity. Excess loss carried over until there's more tax basis incurred. Increases the tax basis. If you invest more cash, more basis. A share of undistributed income. Say my partnership that I have, my McDonald's partnership, makes $50,000 of income, 25% or 25 to me, 25 to my niece. I get $25,000 of additional basis as a result of that. Share of debt. In a partnership, share of debt is going to increase what we call debt basis. In an S corporation, not necessarily so. The only time that you're going to get additional debt basis is if you are personally loaning money to the S corporation, and that's the only way that kind of happens. Decreases the tax basis, cash distributions, and prior year losses. So for example, if I have losses, and they say prior year losses, I would say share of losses for this year are going to decrease your basis. Okay, it's not just prior year losses that are going to count, but if you have prior year losses that are suspended, it could definitely decrease basis that's generated this year. Another thing they don't put on this list, which I think is important, is payment of the debt that you have. So if you have debt basis, say $30,000 of debt basis that's built up, and your losses that you've taken in the past have required you to eat $20,000 of that debt basis, if you pay off more than $10,000 of that loan, you're all of a sudden now going to have a taxable gain event. Don't worry about that for the first test. It's not going to happen on the first test. We're probably not going to talk. We'll talk about it in the third section. I'm not even sure it'll be on the third section's test, but we'll see. At-risk limitation may not exceed the investor's amount of risk. And what's risk? So if this business goes belly up, what do I lose? Okay, if I lose nothing, then there's no risk. If I lose a lot of money that I put into it, there's risk. You see what I'm saying? So there's that, and usually that has to be calculated. I've only seen probably about a handful of times where this has sort of come into an effect for me and my clients. For the most part, at risk is usually you're going to hit the other two before you hit the at risk concerns, because usually if you've got basis, and most of the time when we're dealing with this, the clients are they're fully involved in the activity, and so that's why there's not going to be too much of a risk issue. Tax basis on an at risk limitation question, we're going to skip. Passive activity limitation. So losses from passive activities may only be deducted to the extent the income is the taxpayer's passive income. What that basically means is that if I own 6 rental houses and I lose $150,000 on said rental houses, I can't take any losses on those $150,000 in a year until I have $150,000 in income. Okay. Now there's certain exceptions for rental real estate. They give you a $25,000 exception to that as long as you make less than $150,000. It's up to $25,000 if you make less than $150,000. But we'll talk about that more when we get to that part. Participants in then they said past activity is a trade or business. The taxpayer does not materially participate. We've already talked about that. I won't go on. Testing for material participation. Okay, so here's the thing. You may not be actively participating in the activity, but you may have been materially participating in the activity. Now, what does that mean? So in order to qualify for the $25,000 loss, you have to be materially participating in the activity. In other words, you can't be simply sending money off and have no contact with that activity except for when you get your money back, and that's it. Okay, you have to be actively working with that company, but it's still technically a passive activity because rental real estate, by definition of 469 subsection C, is automatically passive. Okay, but what if you do spend a lot of time doing with this? And then what they'll say is an individual participates in the activity more than 500 hours in the year, and the activity contributes substantial all participation in such activities by individuals, including non-owners. You have to meet one of these tests. Now, very good example, I have properties that I rent out. I spend more than $500 in managing those properties, 500 hours in managing those properties. I also have property managers deal with it. Now, they obviously spend even more time managing my property than I do, but that's just because that's their job, okay? You know, so, and the problem that I have is that my 500 hours has to be spread amongst the other properties. So maybe my managers spend more time in it than I do, but that's what I pay them for. Okay, so there's ways that I can kind of get around that. The individual participates more than 100 hours, and the individual's participation is not less than any other participation in the activity. The individual activity qualifies as a significant participation activity. And then the individual materially participates in the activity for 5 of the preceding 10 tax years. So if you have 5 of the, a very good example, this happens with military people a lot. So they participate materially in their investments in their rental real estate, and then all of a sudden they get called to go to Iraq, or they get called to go to Afghanistan. And they're basically told, okay, you're going to go do that. Obviously, in the middle of dodging bullets and kicking down doors, they're not going to be contacting their rental real estate manager and saying, okay, tell me all the stuff that's been going on. They're focusing on the fight, and they should be. Okay, that's the important thing. The spouse and other those people might be dealing with some of that stuff on the side, but generally the manager, before the person goes on deployment, they're going to tell their manager, hey, you got free reign to do whatever you need under these rules. Go ahead and do this. So maybe in the last 10 years, maybe in the last, we'll say for the last 10 years he's participated materially in the whole thing. As he spends 1 or 2 years over in Afghanistan or Iraq or out of the country where he's not really focusing on this stuff, obviously, in 5 of the last 10, he got it, so he qualifies. Short-term absences from that are not going to cause any issues. Health reasons are going to cause some of that problem, too, that you could have with that. The individual material participating for any of the 3 preceding years in a personal service activity. So if you're personal services is health, law, accounting services, or architecture, and then taking into account all the facts and circumstances the individuals participating on a regular, continuous. This is what we call sort of the catch-all facts and circumstances. Okay, so what you're going to notice is that tests 1, 2, 3, 4, 5, and 6. Well, actually 1, 2, 3, 4, and 5 are all mechanical. Okay, you either are or you aren't. It's like love. You either are in or you're not. Okay, you don't get to be able to sit there and say, well, I'm kind of there. Okay, that's not the way this works. You either, it's a mechanical test. 6 is actually kind of, I guess now looking at it, it's also a mechanical test. 7 is taking all the facts and circumstances. When you say the words facts and circumstances, that is not a mechanical test. That is basically a, hey, we're going to use our common sense to just say, yeah, this is. So taking into account facts and circumstances, the individual participates on a regular, continual basis. So that's kind of the catch-all where we talk about the sort of facts and circumstances. When you see facts and circumstances, that is not a mechanical test. Okay, in a mechanical test, it's like I said, it's it's like love. You either you know it because you got it, right? Facts and circumstances are going to kind of back off and say, okay, we don't have something that definitively is the line that we've crossed, that we know we are or we aren't. So what we're going to do is we're going to say, according to all facts and circumstances, is this person really, if you think about it, it's kind of like water. Is water hot or cold? I can take a thermometer and dip it in. That's a mechanical test. Okay. Another way that I can kind of look at it is, okay, well, it's moving. The temperature around it seems to be pretty warm. I touch it and it feels like it's warm. I don't see steam. I don't see ice in it. So chances are the water is probably going to be warm. I can just take a look at all these different cues that are kind of around it and kind of come to this conclusion that they really are. And that's kind of what facts and circumstances are. Okay. Okay, so that's all I really got for Chapter 7 at this point. You know, and we'll talk a little bit more deep dive when I get back. For the most part, you know, like I said, we're going to do the review of the test, and then we'll whatever class we have left over. We might get into Chapter 8 when we kind of talk a little bit about that last thing. I'm not so sure that we're going to put Chapter 8 on the test. We haven't in the past, and I don't think now would be a good time to start doing it. But if you have any questions, feel free to email me. I will be checking my email. Do me a favor and email me with my business account, because I will be checking that far more frequently than I'll be checking any other account. Only because you know, we're still in the middle of that individual tax season that we have to get past. You know, I think class is going really good. I think that we've got some opportunities to do some great learning. If you have any questions about this, go ahead and put the questions into the comment section of this video below, and we'll be able to take a look at that and see how we proceed with that. Again, if you have any questions, reach out to me. Thank you very much.